morning. It is Wednesday, February 1st here in New York City. Happy February. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sazi. And if we take a look at futures here this morning, a little bit lower as investors await today's big decision by the Fed. Here are three things you need to know this morning. A bullish or bearish message for the markets. Federal Reserve Chair Jerome Powell will speak at 2 p.m. today after the FOMC makes its decision, expected to make its smallest rate hike in nearly a year of 25 basis points.
And Snap's market value is vanishing following another brutal earnings report. The company's weak outlook casting fresh doubts on the social media play's future.
And Advanced Micro Devices, or AMD, topped earnings expectations for the fourth quarter despite slowing demand for PCs. We're going to dive into those earnings in just a minute. But first, let's take a look back at what some investors are calling Big Jan out there in the markets as we start a new trading month here in February. You've got one friend of the show, Carson Group Chief Market Strategist Ryan Dietrich, calling this the bullish slingshot and saying it is here. And here's why. Because after a big January like the one that we did see in the markets, the average full year gain is 29% for the S&P 500, and that's coming after. That's when we have that big January after a down year, which is exactly what we see. Now, in terms of some of the sector performers over the course of January, you had the outsized move to the upside in consumer discretionary, also communication services. That moved higher by about 15% as well. In addition, some of the other largest decliners in 2022 were the biggest or outsized move to the upside in the beginning of 2023. Technology and real estate, both of those up more than 9%. Let's also take a look at some of those individual movers. And for some of the mega cap tech stocks, that's where you actually saw the biggest rebound here. Take a look at Tesla. That moved higher in January by about 40% there. Nvidia also moved up by about 33%, 34%. Amazon, also a big move there. So that just kind of continues the theme for some of the bigger decliners, the largest decliners that we saw getting a little bit of a rebound coming into the start of this year. But again, it's all still relative here as well.
Yeah, exactly. And really the question is, will the Federal Reserve come in here and want to smack down the advances that we have seen in the market? That's the big question. We have seen that happen before, right? With past meetings where the Federal Reserve and its participants felt that the action we were seeing in the markets did not fully reflect the outlook for rates. So then that raises the question of, are we going to get different rhetoric here today from the Federal Reserve? Yeah, and it's to be determined. I'm looking at this good note from Goldman Sachs. I love their research, but this is the vibe coming into this Fed meeting. Goldman notes this. How many rate hikes will be needed to stay on this path is less clear. They expect 2 additional 25 basis point hikes in March and May, but fewer might be needed if a weak business confidence depresses hiring investment, or more might be needed if the economy really accelerates. So it's just absolute confusion, I would say, into this meeting, and that ultimately falls on Jay Powell to come out here and just, I think, provide clear guidance to a market, to Brad's point, that just had a big Jan.
Yeah, and so within that big Jan, what you had the absence of, as we've been discussing, was the Federal Reserve here. And of course, that meeting, that FOMC meeting kicking off on the 31st, and now we'll get a decision here today on the 1st of February. One huge thing to continue to keep in mind going forward is, of course, not just how much of an outsized impact any type of pause or pivot could have on the markets and the reaction that they may have in celebration, but then to the other side, what if the Fed goes against what that expectation is and actually is still remaining more aggressive, almost kind of heeding the advice of the IMF? I mean, I feel like that is kind of the expectation at this point. I mean, it feels like the market is leaning a little bit more on hawkish expectation than dovish expectation at this point. Yes, we've seen the big January rally, but then over the past couple of days, we've seen a little bit of shakiness to that rally. So I do wonder if investors are sort of bracing themselves rather than thinking the Fed's going to. I think there's little chance that the Fed's going to signal an all clear here. And I think execs are waiting too. And I know I'm guilty of this too. I always view that execs don't pay as much to the Federal Reserve as we here do in the business news community. But, I spoke to Otis's CEO, Judy Marks, and, she's paying very careful attention. They reported earnings this morning, they beat, but they very careful attention to the outlook for rates this year. And she made a good point that if rates continue to go up, it might impact their backlog and their business plans later this year in terms of new development, not just here in the U.S., but Europe and certainly China. Well, that's kind of the sentiment that you heard even from the conversations you guys were having at Davos, because from what the execs were somewhat signaling is that we can't really do anything about what the Fed is going to do. They're going to act as they feel necessary for the economy, but at the same time, we can be as proactive, and in some cases they've been extremely reactive, but as proactive as we can in this instance, which means drumming up new business deals, which means some of the cost restructuring within our own company and corporation. And I think at this point too, for what they're listening for from the Fed, it's more about how the demand environment can impact them if they continue to be hawkish or aggressive from the Fed, how that impacts their own consumers that they're going after right now too.
Yeah.
Also, let's talk about Snap. Snap in focus this morning after reporting mixed earnings. And according to CEO, the flat year-over-year growth reflected the rapid deceleration in the company's digital advertising growth here. You're taking a look at shares pre-market lower by about 12% here. And one thing that jumped out to me from the call was just what they were sensing in terms of the ad spend and the conversations with their partners, saying that it seems like advertising demand hasn't really improved, but it hasn't gotten significantly worse either. So the big question there is the worst of that advertising demand environment starting to be priced in at this point and coming off of a quarter where those results are finally starting to be realized by the street and how much it would have impacted a brand like Snapchat?
Right, Brad. And I think the market also wanted to see some evidence of all the massive cost cutting that this company did. They were, in many respects, one of the early tech plays last year to lay off just thousands of employees. Snap said on that call last night, those bottom line benefits won't really start to be seen to the first quarter. But still, this was another ugly quarter from Snap. And I think James Heaney over at Jefferies absolutely nailed it in his note this morning. He's saying this: we are concerned that Snap's issues are intensifying as recent ad platform changes further pressure revenue growth and depth of engagement on friend stories. Again, just not a good quarter and not a good outlook from this company. And what that reads through to Meta, unclear when they report later on. But still, this is a social media outfit that remains very much operationally challenged.
I think, so you're going to sense, viewers are going to sense a theme throughout the earnings season and today's show in particular, and that is, are the problems at this company specific to this company and reflective of poor leadership, or are they reflective of the broader economy? We're going to talk to Bill George about that later in the show, the former Medtronic CEO, and I think it's a really good question for Snap in particular. That sort of encapsulates this, right? Jessica Lesson over at The Information likened Snap's strategy in her note last night to throwing spaghetti against the wall. It sees what's happening in terms of this slowing demand environment, in terms of slowing ad spend, and it's just trying all these different initiatives to try to get new viewers to come in, new users to come in, and to try to monetize them. And it's trying Spotlight, which it says it's seen some success with. Users are going up, but then the monetization piece needs to come as well. So all of that spaghetti being thrown against the wall, it's certainly not bearing fruit as of yet. And in fact, are we seeing Snap having to go back in order to go forward? Yeah,
and on that user number, 375 million daily active users, that reflected about an increase of 17% year over year. Perhaps there is an inclination to believe that if you did have some of those core consumers that were saying, you know what, I'm not going out shopping at the same rate because I'm more concerned about how much I'm going to be paying up, or if I'm not going to one kind of physical social construct or another because I'm trying to, monitor my own discretionary spend, then maybe I'm spending more time in an app, just engaging with my friends. And for Snap, what they would hope to do is convert a lot of that time that is starting to increase perhaps on the shoppability within the platform itself too. And that's where they've been investing more. That's where they started to talk about one of the bigger bets that you were mentioning a moment ago in direct response marketing campaigns that it seems there's still a lot of propensity from some of their partners to spend on right now.
Julie, your point on leadership, it's spot on. And I think it's two-pronged with Snap, but also I think it leans a little more to leadership. Remember when we covered that IPO of Snap way back when, they launched as a camera company. Yeah. And now if you go to the investor relations page, they're a tech company and they're still not doing well.
They still are talking about the camera. They're still leaning on the camera angle as well, though. They're talking about AR. Mm-hmm. They were asked on the call also about how they're going to incorporate AI, because it's important to remember AI isn't just chat and text, it also is visual, right? There's visual AI. There's now I'm blanking on the name of the company.
Generative AI?
The one that changes the pictures.
Anyway,
we know. Anyway, it all feeds into that. So he talked about that being an opportunity going forward for the company, of course, because every CEO right now is contractually obligated to say they're going to take advantage of AI in some way. So they're definitely on that bandwagon as well.
He also mentioned AI for the first time. That is AMD. So let's get into that one. Chipmaker Advanced Micro Devices topped earnings expectations for the fourth quarter as revenue grew 16% year over year despite a slowdown in the PC market. Here's Yahoo Finance's Dan Halley with what you need to know on AMD's earnings.
Chipmaker AMD beat analyst expectations on fourth quarter earnings despite slowing PC sales across the computing industry. Here's what you need to know. AMD topped analyst estimates on both earnings and revenue for the quarter ending in December 2022. The U.S. chipmaker posted revenue of $5.6 billion on strong growth in its data center business, which grew 42% year over year. This comes on the heels of a dismal report from rival chip giant Intel, which posted disappointing losses for Q4. As a whole, the semiconductor industry is facing a steep drop in PC sales as consumers choose to hold on to the computers they purchased at the peak of the pandemic.
Of course, there is a cyclical aspect of it that PCs were one of the biggest beneficiaries when we were all locked up right at our homes during COVID. So we are seeing the other side of it.
Not immune to weakness in the PC market, AMD reported a 51% decline in processor shipments from this time last year. According to market research firm Gartner, overall PC shipments declined a stunning 28% in the fourth quarter. That's the biggest fall since the company began tracking shipments in the mid-1990s. These issues are bleeding into AMD's video game division as well. The company reported a 7% revenue decline for its gaming segment year over year. Still, the chipmaker's data center business remains strong, outperforming its peers and posting $1.7 billion in revenue for the quarter, up 42% since last year. Looking ahead, AMD is warning of a 10% revenue decline year over year for Q1.
Helpful stuff there by our very own Dan Halley. And it is interesting to read the analyst commentary here this morning. The street universally still loves AMD, but there are a lot of analysts now looking for at least one more profit warning from the company because of the ongoing PC correction and some slowdown in the data center market, in large part because of a slowdown in the cloud business. So the street they love the company, they love CEO Lisa Su, but they're bracing for more bad news.
And across the semiconductor space, it's a heavy investment period too. And so even as you're kind of looking out over these next 10 years, perhaps, this is where you start to get into the conversation, or at least some analysts have floated the idea of this golden decade that we may be entering into. And it raises this larger question of, well, are we at the trough of that point so that investors can get a better sense of where within kind of the growth opportunity or that next growth cycle for semiconductors, where they can expect to see the bottom set in and actually start to monetize or at least see some accretive nature to some of those investments too.
Yeah, AMD shares up about 16% year to date going into the report, which is about in line with what we've seen from the Philadelphia Semiconductor Index. I think your point, I can't remember which one you said, on Intel is a good one, right? That, analysts still like AMD, and AMD in part, like if it didn't have that sort of foil, if you will, or that sort of competitor that throws its results into relief, you wonder how it would look. But I mean, you have Intel to compare it with, and Intel looks really bad. Yeah. So by comparison, if you're going to buy a big chip maker in this particular segment, the choice right at this point is probably pretty clear for people.
And you mentioned AI, and that is becoming the buzzword of this earnings season. I think a lot of executives have been told, mention something about AI on your earnings call because ChatGPT is so hot, and mention it even if you may not be working anything on it. AMD did mention AI for the first time ever on its earnings call. AMD, of course, will have a role, some form of role in the future of AI. But if you hear, this is just a warning to all investors, if you hear a supermarket company talk about AI, it's a red flag. I mean, you have to know what they're working on. And at least with AMD, at least they're in tech. So yes, you can see them doing AI.
What about the robot that cleans the aisles? It can be
is that
smart,
AI?
It doesn't bump into.
Is that AI?
No, it's not AI. I don't
No,
know.
AI is getting the same treatment in 2023 that blockchain got in 2017.
Yes.
Yes. And that's exactly what we're seeing some of the biggest reactions on, or at least some investors really playing up. We saw C3 AI move higher by about 21% yesterday, still higher here pre-market as well, on an announcement about a product suite, which is probably something that they were already working on years ago anyway.
And they should be doing AI. It's in their name.
Well, listen, it's interesting and it's exciting. It's just a question also where we are in the cycle for it. Are we too early? We've gotten excited about a lot of things over the past few years. Autonomous driving, the metaverse, et cetera. Some stuff that was already around, they just relabeled it as whatever the hot new thing was.
Right, cannabis plays.
Right, so, I think we have to obviously keep our eyes open.
I'm getting
this stuff, even if we're excited.
I mean, we can't forget about Watson, IBM Watson, as we were discussing in a couple meetings ago. And I mean, for IBM, they've started to just ratchet up some of that social media advertising showing up in my Twitter timeline, at least yesterday here too. So
IBM's still advertising on Twitter, huh?
Yes, they are.
Oh, we got a little reporting. All right, from AI to something more traditional. The Biden administration unveils its latest round of key infrastructure investments. We'll speak with U.S. Transportation Secretary Pete Buttigieg next.
Were you a little surprised by McDonald's blowout sales for the fourth quarter? Of course you were. Well, maybe you weren't. I don't know. A restaurant posting double-digit sales gains with recession fears swirling is no small feat, even if you sell value food like McDonald's. The surprising sales strength caught the attention of Saz. He did a little diving into the company's earnings call.
Yeah, I'm always looking for reasons of things for companies, life, well, you name it. And I went back and I was just rereading our very own Brooke DePalma's coverage on McDonald's and also the company's earnings call to try to understand where these blowout sales gains came from, with a lot of pressure on consumer wallets here. I mean, you normally don't see double-digit sales gains from McDonald's, even considering there is inflation. One thing that stood out to me was the data around digital, McDonald's digital. I was just shocked by some of these numbers here on how fast the digital business is growing for McDonald's, and I think really playing a key role in driving these double-digit sales gains. Fourth quarter, digital represented 35% of system-wide sales in McDonald's top 6 markets. That's pretty huge. Last year, the McDonald's app was downloaded over 40 million times in the U.S. That is absolutely massive. McDonald's also calling out 50 million active loyalty users in our top 6 markets. And this really reflects McDonald's app just getting better, where you can obviously pay and order and have all these things delivered, and they're giving you rewards. It is just a good app, and that was not the case a couple years ago. Underscoring this importance, good to see a good quote on the conference call from McDonald's CEO Chris Kempczynski saying, digital sales gives us such an unlock to get more tailored in the experience, the offer, products, and we're delivering to our customers. So I think for us, if we can get there on digital, that's going to be a big opportunity. It looks like that opportunity is in fact already starting to play out. And then speaking of digital, the company appears to be firing on all cylinders, at least on its earnings day on digital. It was an interesting tweet they put out yesterday from the McDonald's account. There you had Ronald McDonald being spoken in the same as when you text your ex and they don't respond. Of course, this has nothing to do with McDonald's digital, but again, just I think digital top of mind McDonald's. I think that's a pretty creative tweet. One interesting way to use Ronald McDonald. When I grew up, they used him in commercials. Now they're talking about dating in Ronald.
Well, I mean, I think they're trying to keep pace with Wendy's and how well they've done on their social accounts as well.
Yeah.
And then when I think about the digital component that you were mentioning a moment ago, I just immediately think to myself, it's me. Hi, I'm the problem. It's me. Because at the end of the day, I am the one that's placing so many digital orders. That is the new kind of way that people are saying, you know what? I'm seeing value, but I'm seeing it still in having the Happy Meal or having those McNuggets delivered via Uber Eats or just placing an order that way easily and not leaving the comfort of my couch. And so for those deliveries, I'm probably a line item in some of those.
Yeah, no one wants to go drive and pick up McNuggets in this day and age. Just order. But here's my take, and just staying on of all things digital here at McDonald's. McDonald's app, good in my humble opinion. Dunkin' app, not good, which is unfortunate. Dunkin' has made a series of updates, and I'm a big Dunkin' guy. I'm constantly ordering from there, but I think the rewards program is still very confusing. It is hard to navigate. I encourage everyone to just, if you want to better understand this McDonald's digital story, go into the McDonald's app, try and play around with it, and go to the Dunkin' app. You will see that it is a much more slick, easy-to-use interface for McDonald's, perhaps explaining why they're winning a lot of good business, and maybe in terms of coffee, maybe winning some business from Dunkin'.
I've spent a lot of time in that Dunkin' app, and I think for all of the app comparisons right now, because users are able to compare a McDonald's app, you're able to compare a Domino's app even if you wanted to, and then additionally you could weave in Starbucks app. And all of those different app experiences, it's so core to the value experience that a customer is taking away. And that ease of ordering, I think, is what's so imperative for all of these companies to get right, and then try to upsell within that app experience.
Yeah, I mean, I feel like Starbucks and Chipotle are the two that have made it not something that's on the side, not something additional, but just sort of part and parcel of their operations. And so those seem like the models to follow for other companies. All
right, let's switch gears here. President Joe Biden spoke yesterday in New York about a new $292 million grant to build a new tunnel connecting New York City to New Jersey and the rest of the Eastern Corridor. The Hudson River investment, just one of the big projects coming out of Biden's infrastructure law, as he hopes to build a contrast with Republicans. Another part of that spending package announced today, with the Department of Transportation announcing $800 million in grants for new projects around the U.S. Here to talk about that is U.S. Transportation Secretary Pete Buttigieg. Mr. Secretary, always nice to hear from you here. A lot of money in this latest plan. Where will it be going, and what do you hope to achieve?
Well, we're really excited about this latest round of grants. 9 communities or areas around the U.S. getting grants for what we call mega projects. These are the cathedrals of our infrastructure. Projects so large, so complex that they often can't be done with traditional funding mechanisms. And so we're making sure with some of the funding from President Biden's infrastructure plan that we're helping get them to the finish line. Yesterday, I was with the president celebrating that first major piece of the Hudson River tunnels. That will stand as one of the biggest infrastructure projects going on in the United States for many years, because it involves replacing tunnels that were built in 1910 that we rely on every day. Hundreds of thousands of people go through there on trains, and it's really a specific place, but one of national significance. We're funding the Brent Spence Bridge. This is a bridge that needs to be replaced connecting Ohio and Kentucky. And the president was there with Mitch McConnell, signaling the bipartisan support for this kind of work, announcing that project recently as well. We've got, again, 9 projects that are part of that fund, and hundreds of places around the community that we're announcing today are getting grants to make their roads and streets safer. All part of the president's infrastructure package, and really I think shows you what it looks like as we get out of that early phase of just getting this bill passed and getting those programs set up, and now starting to move this funding out to communities, to states, to transit agencies to get the work done.
Mr. Secretary, it's Julie here. I don't know anybody who is happy about infrastructure as it exists in this country, right? A lot of people have gripes about whether it be their local roads, their airports, et cetera. Especially when you compare it with, say, other nations. How long is all of this going to take to sort of get us up to a better level? And then what kind of economic growth is that going to unlock once we are there?
Well, the hard truth is that we have, we have a backlog that has built up over decades. But the good news is we have changed the trajectory of infrastructure in the U.S. Instead of each passing year hearing Washington talk about a so-called infrastructure week without any results and watching that hole get deeper, that backlog get longer, we're now moving in the opposite direction. This is the most funding we've put into roads and bridges since the interstate highway system was created in the first place. This is the most we've done for trains since Amtrak was stood up 50 years ago. And it's going to make a huge difference. Now, before you even see the first ribbon cuttings and the first projects completed, what you're going to see is the first hard hats and the first families' lives that are changing in the form of the workers who are working on this. The Hudson alone expected to ultimately involve some 70,000 jobs. And as we look at the projects across the country, they're creating good-paying jobs. It's really a pipeline of good-paying construction jobs. Jobs, by the way, that you can do whether you have a college degree or not. They take a lot of apprenticeship training, but we're talking about money that you can build a family and raise a family on. And it's a big focus of the president, building up that middle class. And we're just thrilled about what is going to be possible in the near term, and then eventually in the long term, of course, the millions and millions of American jobs that will be supported by having that better infrastructure, the better airport, the better tunnel, the better bridge, the better train, so that we can all get to where we're going.
You said the better airport. These are, of course, no doubt, significant investments, significant grants moving forward. But when we think about aviation and what we just saw over the course of the holiday season and what your department has initiated in terms of investigations, and where some of the pitfalls actually took place. What have you been able to take away from some of those early investigations? And what type of dollar figure could we see invested in making sure that the FAA has the tools, the software that it needs to act and be a more modern operation?
Well, in short, we've made a lot of progress and we've got a long way to go. Last year, we toughened consumer protection standards, make sure that airlines treat passengers better. We got written commitments that we can enforce, including with penalties. And that served us well when the Southwest debacle happened, because it meant that we could not just urge them, but require them to make good on commitments around things like covering hotel and meal expenses, rental cars, and flights for passengers who got stranded. We got more work to do on passenger protection, and I'm excited about some of the things we have in the works for this year. Then you have the systems side. The FAA has been in the process of modernizing some systems for many, many years, and we've got to find ways to pick up the pace. For example, the system that had a problem that caused about an hour-and-a-half outage earlier this month, that's something that is in the middle of an upgrade that began in 2019 and is only scheduled to be completed in 2025. Obviously, I'm interested in how we can shorten the time to deliver that. So we're going to be working with Congress on getting more of the funding that we need in order to have these systems modernized. Think about the challenge of replacing the backbone of a system that you can't ever turn off, right? The air traffic control system has to be running 24/7 by 365. You can't just, close it down for the weekend and use that to reboot everything. And that makes it extraordinarily challenging. And the bottom line, of course, is safety. That's why all these technologies exist. It's why the FAA exists. We have to preserve an extraordinary safety record where we have many years with zero commercial aviation deaths on airlines in this country, and still make a lot of changes to a system that we've been counting on that's really kind of bolted on piece by piece since the 1950s.
Mr. Secretary, over the past week, we've heard the likes of Tesla, General Motors really play up their ongoing push to make cars drive by themselves, level 3 technology, level 2 technology. It's mind-blowing stuff, but the investments you're making here today or announcing today, does that set the roads up to support the technology these automakers are trying to push through?
So that's one of the biggest things we're looking at right now, the way that automation and artificial intelligence is going to change the transportation experience for years to come. There's real promise in the technologies that you're seeing from the automakers. Eventually, I think they could potentially save many, many lives. But right now, we're in a period where the technology cuts both ways, and I'm very concerned about car owners relying too much on technology that is designed to assist a driver, not to replace a driver. I think it's really important that people continue to understand it. It's great to have these assist things that keep you in your lane, let you know when you're close to a car in front of you, but even the most advanced, most sophisticated, most fancy car you can buy today still absolutely requires that you have your hands on the wheel and your eyes on the road. And we need to make sure that that technology evolves in a safe fashion. We also have to recognize that there will be technological developments in this decade on top of the ones that we're following closely. Automation, things that are happening with AI in the vehicle, drones. There are also going to be some things we probably don't see coming. The most important transportation technology the last decade is arguably the smartphone. I caught part of your segment on the different apps. I was thinking about how I use the McDonald's app when I'm changing planes at O'Hare to quickly order something up while I'm in my layover. But of course, more significantly for transportation, led to the rise of things like Uber and Lyft and changed how we navigate our communities. So we're trying to make sure that we're setting up for a future where you don't have to guess which technologies will win and lose, to know that certain things just have to be done. The tunnels, the bridges, the airports, things that we have needed to do for a long time, we're finally getting done, and we're going to be glad we did them, no matter what the future throws at us.
That's a very good point on the apps. For me, Google Apps was the one that really transformed, and thankfully, usually gets me where I need to go. Transportation Secretary Pete Buttigieg, thank you so much for your time this morning. Really appreciate it.
You too. Thanks a lot.
Thanks. Let's take a look at the opening stock prices, shall we? Because we just saw the opening bell ringing while we were speaking with the secretary, and we do have a lower open here this morning. The Dow down by more than 0.5%, the S&P off about 0.25%. The Nasdaq little changed here, but obviously what's going to set the tone broadly is going to be the Federal Reserve decision, and more importantly, the commentary this afternoon. But while we wait for that, we have other stuff that is setting the tone for us, and Saz, among them, of course, earnings. Still a lot of earnings to watch.
These earnings are not that great, and I've continued to just key in on what these companies are saying about operating expenses. And I highlight a company like Snap. Little nugget, I have a video going out, this 30-second Snap going out on Twitter very soon from the Yahoo Finance account. But Snap noting that employee headcount down 20% from the peak in the second quarter of last year. So really, these expense cuts by tech are starting to flow through, and it could be an interesting first quarter where sales start to still under pressure for a lot of these companies, but the profits just might be there.
Yeah, we'd seen over the course of January with some of the ripping of the Band-Aid, if you will, and that communication or somewhat transparency to Wall Street about the different tech layoffs that were taking place, and even more so than just tech. With each one of those announcements, it kind of gives this broader question to the workers out there, to the employers, of where exactly we're at in this cycle for not just hiring, but also for any type of kind of job transition that may be taking place. And that's where it's still important to remember that there's nearly 2 jobs for every unemployed person at this point in time. It's just a question of if you continue to see layoffs of this magnitude and companies continue to come out and say, yeah, we overhired because we anticipated that the demand environment would stay stable. Well, that might have been a naive anticipation. So now it's just a question of, on the back of the demand environment that we have right now and what they're projecting, where that growth could still set in and where you start to still see people be able to come into the fold that certain companies do.
Good point indeed. All right, coming up, is it time for a big player to ride the Peloton bike? The stock is climbing higher on the back of its earnings report, and as takeover talk continues to swirl. More on that story next. Pandemic darling Peloton sees net losses narrow in its latest quarter, while subscriptions generate more revenue than hardware sales. CEO Barry McCarthy pointing to this trend as gross margin accretive, and the persistence of it would represent a turnaround in the business. Just bottom line, not a good quarter from Peloton. I understand what Barry's talking about, improvement in the adjusted operating profits, improvements in the free cash flow, so less negative. The outlook not good. Subscribers not good. And then he points out what I count as 11 things on his plate of to-do list, at least this year. One of them, return to year-over-year revenue growth. That would be good. Unclear how that's actually going to happen. Sell an Ohio manufacturing facility. That was supposed to be sold last year. That didn't happen. And then restructure middle-mile warehouses, continue restructuring the retail store footprint. Lots on his plate. A new leadership team in tow here. Just not good. None of it's good.
I mean, his message seems to be, if you look at sort of interviews that he's giving and press he's doing, the message seems to be, we're surviving.
Yeah.
But like,
that's not a ringing endorsement
no,
that
it's
buy
not,
our stock because we may be around in a year or two.
But I guess people are buying the stock.
Well, yeah, I mean, and he said last year as well, turnaround's hard work, intellectually challenging, emotionally draining, physically exhausting, and all-consuming. He can expect all of that to be the case here with this potential turnaround or epic comeback, as he was calling it, within the release. But I think you also need to think about the fact that Peloton and what they signaled in the guidance from this point and into next quarter is that they're not going to be prioritizing the same type of connected fitness device growth that they had seen even this time last year. And so 2%, it seems like sequential growth is what they're going to be looking for from this point. And that sequential growth is what's key to track at this point, because the year-over-year comps are going to be dismal for a little bit, at least if you're comparing it to the next, even going into this next quarter, it's still going to be a bad comp. And so now you get into the point of, all right, you've got all these partnerships, United Healthcare, Dick's, Amazon, Hilton. What does that signal for Peloton? It signals that they're not necessarily trying to position themselves as a pure play fitness company anymore. It's how do we position the brand as a wellness company that just happens to have devices that are able to help keep people fit. And I imagine the next play could be even more into the healthcare landscape, where they're saying, all right, yeah, you can get a discount on this bike as long as you're able to pass that info through to your healthcare insurance provider as well.
Or maybe put a bike in the doctor's clinics, and while you wait in line, you can take a bike. But no, really, no, 3 months ago, we hammered Barry for these investor letters he's been putting out. He just passed his 1 year mark. Didn't like that letter last time. This one was a little more subdued, even though, Julie, he did tease, I think, an epic come around. He used epic turnaround for the company. I mean, I don't see it, and it's not in the outlook.
The bikes don't turn. All right, let's take a look at Electronic Arts. It takes a hit after missing analyst estimates in its latest quarter, citing impacts from the current macro environment. The video game company also is reducing its guidance for the full year 2023. Those shares taking a hit of 11% this morning. The company says net bookings for its fourth quarter are going to be $1.68 to $1.78 billion. The estimate from analysts was $2.22 billion. That's its fiscal fourth quarter. Obviously, it's not on the calendar year. So, that's not good news here. And analysts here definitely not happy about these numbers and talking about that essentially the new games are just not selling as well as they should be.
Yeah, FIFA was good, but there was one thing that I highlighted within this performance of new games, and they did have some strong reviews for those new games, as they noted, within the Apex franchise. However, it was still below the levels that they had anticipated. That trickled through to some of the actual results, and they still have this softer net bookings trend, and you can expect that to remain intact for at least the foreseeable near-term future.
And one structural problem I want to call attention to, and actually this was brought up by Jefferies, Andrew Urquhart, who covers the space, increasing game complexity. So these games are just getting increasingly complex to make, and with that comes higher costs, potential game delays, and it's not just an EA thing, it's an Activision Blizzard thing, and that's a Take-Two thing, and it certainly has been a Take-Two thing because they've reported 2 disappointing quarters and have really let Wall Street down.
That's why I stuck to Tiger Woods PGA Tour golf.
Best game ever.
Well, and I'm not a big gamer, but like, aren't most games at this point, don't you have to kind of watch a video on YouTube to figure out
Very
how to
hard,
get
Julie.
to the next
You're right on
layer
it.
of the
You're right on it.
game.
You can't pick up the controller and play these anymore.
Right.
You got to
exactly.
study just to do well. It's a part-time job, full-time. All right, let's talk about Match.
Speaking of full-time job.
Yeah, speaking of finding love,
Hey.
yes. Shares of Match Group, they're feeling the love here today. After missing estimates for its latest quarter, the online dating app saw revenue decline 2% over the year prior as revenue for its brand Tinder came in flat. However, I would say that they're about willing to bet the house on Hinge here. They had some strong performance within Hinge. Hinge direct revenue, that grew nearly 30% year over year. And they also took some action to move up Justin McLeod, at least, and he is the founder and CEO of Hinge, at least in his reporting structure there. So bringing him closer to the CEO, at least in a direct reporting capacity.
I'm just looking for simple analysis today. It's been a busy morning for me. This quarter for Match suggests that this notion that finding love is recession-proof, that's not the case. I think Match saw a lot of consumer pullback, notably in the Tinder business. So that thesis, you can toss that right in the trash.
Because they're relying on people
like a bad ex,
to buy further into the experience. Well, yes, actually. And if you ask McDonald's, they would say, why did you text in the first place? McDonald's would say.
You're right.
Yes, Ronald McDonald has some words,
Julie.
has some looks for you. I mean, I don't know off the top of my head which is bigger. I mean, I know that Tinder is bigger than the company. It makes about a little more than half of the company's revenue, I believe. So the question is, if Tinder really falls back, how much can they lean on Hinge, right? How great can Hinge do, and how much of the slack can that pick up? I mean, they're talking about $400 million is what they expect of direct revenue from Hinge in 2023. So we'll see if that...
Their year hinges on this brand, Julie. Really? Too soon?
Don't put that on your dating. Don't put that joke on your dating profile, please.
Coming up, guys, job cuts are brutal, but slowing the labor market was always part of the Fed's toolkit to battle high inflation. We'll break down that relationship in today's Morning Brief next. Job losses continue to pile up in the tech sector as the giant multinationals that for years experienced high growth rates and led the bull run for stocks are now leading the charge to pare back staff. The Fed has played more than a small role in this, of course. Chair Jay Powell made it clear that pain in the job market was an unfortunate part of the toolkit against high inflation. As Yahoo Finance's Miles Udland writes in today's morning brief, the problem for Powell is that these job losses are what the Fed hoped to achieve. Now, this is part of the, of course, dual mandate that the Fed has in terms of maximum employment, but then price stability as well. And in that employment, they have acknowledged the pathway for their policy may also lead to some of what they kind of have remarked as intended or, just acceptable consequences at this point in time. Unfortunately, I have to categorize it that way.
Yeah, I mean, obviously they are prioritizing price stability over full employment at this point because the employment picture, as we have seen, has held up well, too well probably in the Fed's view, because they are trying to bring down that end demand, bring down wages, right, as a way to help bring down inflation. So these cuts are happening. That they're happening is not the problem. It's that they're perhaps happening enough that is the quote unquote problem. So, politically, it's difficult, obviously, when you see job cuts that are not directly engineered, but as you say, an acceptable consequence of what's going on here.
I am curious on when these layoffs really start to show up in the jobs report. Of course, this is the big week for the jobs numbers. And is the street prepared to see a jobs number below 100,000 on the headline? Well, the thing is, they are showing up in the jobs report, but they're showing up just in certain areas, as we know. When you have the likes of a Chipotle still hiring 15,000 people, when you have Walmart adding people, when you have those service segments of the economy, hospitality, et cetera, that are still having trouble finding people, it's hard to see when that sort of balances out enough to actually result in declines. That raises the prospect. Well, then does the Fed need to keep going on these rate cuts? And then that January big Jan rally could be tossed in the trash.
Well, and then the counterbalance, of course, to the joblessness, if you will, is do we start to see some of the job openings pulled off the table as well? Right. Which would be the serious counterbalance. Precursor. Right. Yeah, exactly. All right. Will that January rally be thrown in the trash? Our next guest thinks investors are ready for a resurrection, but will probably sit on the sidelines until the week is up after the Fed announces its rate decision. Are there still opportunities in some areas, though, like technology, even renewable energy? We're joined by Sylvia Jablonski, Defiance ETF CEO and CIO. Sylvia, it is great to see you. You heard the discussion we were just having about the morning brief here and the sort of conundrum of job growth versus price stability, et cetera. Do you think the Fed is going to be more aggressive here, more hawkish? Is that what we're going to hear today?
Good morning, and great to be with you all this morning. I don't know how Fed Chair Powell is going to go about it. If history tells us anything, it's that he will likely be uber hawkish and will continue to send us the resounding message that the Fed plans to stay higher for longer and the job is not done. And, a lot of this type of activity that tends to pull the market back, which is in your opening why you mentioned why I'm sitting on the sidelines this week. I just sort of don't trust the way that the information is communicated and how the market digests it. But if we take a step aside from that, you can kind of see that data is favorable for the Fed in terms of, what they've been doing. So you have that, annualized CPI down to 6.5% from that 9.1% number. You're starting to see inflation budge in various service sectors and consumer goods and things like that. It's not all sort of rosy and Pollyanna, but inflation is coming down. And I think that the market is starting to look through the idea that, the Fed will continue to really kind of pound us with rate hikes and stay higher for longer. But if you listen to what the Fed says, Kashkari came out the other day saying, if you're playing chicken with us, you're going to lose, right? Those weren't his exact words, but they were the intended words, I think. And that's not great for the market. So uncertainty in the time being until we see, what Fed Chair Powell says.
Yeah, don't want to play chicken with Jay. I think for some of the biggest kind of 52-week declines that we had seen, or at least the stocks that are still on sale as you define them from their 52-week highs here, you continue to keep an eye on semiconductor and machine learning. They have been one of the more sensitive areas as well in the pathway of the Fed's policy here. And so what would you classify as a solid pullback that would kind of be the signal to you to get back in?
Right. And I think if you held a lot of these names last year, you're just wholly unhappy with the performance of these stocks. As you mentioned, they're way down from their 52-week highs to the tune of 20-40%. But I like to look to the longer term, at least a year or two out, but really, 10 years out, particularly for your younger investors or those who are not set to retire in the next, 5 to 10 years. I can't time the market. Most of us can't, but we know that when you have, these names, which are essentially the technologies and innovations required to run our economies and, all sorts of businesses, everything from energy to healthcare to technology in the future, it's sort of smart to dollar cost average in and ignore the noise in the short term. And a great example of that actually is what's going on with semiconductors and some of the tech names. So I think that part of the reason that they're rallying is a lot of the fanfare around ChatGPT and OpenAI. So now there's this sense that, OpenAI is an actual tangible, sort of service and resource that we can use in various fields and industries, and that a lot of these jobs that can't be replaced could be replaced with things like OpenAI. A lot of, kind of like the health tech and research and things like that can be replaced with OpenAI and help our economy expand and grow. But, long story short, I think without the tech names and the semiconductor names, you just don't have things like machine learning, quantum computing, natural language processing. This is all the rage. We're clearly back into looking at it, and those are the names that are going to benefit.
Sylvia, those younger investors that you mentioned, should they be concerned if they're looking to put money to work in some of these big cap tech names? Should they be concerned that these names are now laying off thousands of people and they ultimately will not be able to innovate the same pace looking out over the next few years as they had been the previous 5 years?
Well, I would argue that they're laying off because they're investing in technology that will allow them to innovate at a faster pace. So I think that a lot of the jobs that are replaced are being replaced with things like artificial intelligence, quantum computers that can solve problems. And I don't sort of suggest that this is going to be resolved in the next year or two, but I think that these are investments that play out over a decade. So again, if you're a young investor, you have decades, right, to wait that out. And you have a lot of evidence too that these are becoming real technologies, and sort of the proof of use cases exists.
All right, we'll leave it there. Sylvia Jablonski, Defiance ETF CEO and CIO. Always good to see you. We'll talk to you soon.
Great to see you. Thank you.
All right, inflation is no longer the top issue for Americans, but rather the government and poor leadership. That comes from a new Gallup poll. Back in Gallup's November survey, inflation was the top issue for American households. Coming up, Peloton stock pops on its latest earnings. Is a turnaround brewing? We'll discuss next.
Shares of Peloton are climbing today after the fitness brand showed it had generated more revenue from subscribers than hardware sales for the third quarter in a row. It also narrowed its losses. Evercore ISI Director of Internet Equity Research, Shweta Kajuri, joins us now. Shweta, in the call, the company said, if you've been wondering whether or not Peloton can make an epic comeback, this quarter's results show the changes we're making are working. This is something our Brian Sazi pointed out. I mean, the stock is up today. Is this the beginning of an epic comeback for Peloton? What do you think?
Well, the shareholder letter did use the word epic. My view is that it may not be an epic comeback. It may be a respectable comeback. Because right now investors are very keenly focused on the company's ability to turn around its free cash flow trajectory. More so than the growth trajectory. Back during COVID time period, it was more of a growth name with a lot of subscribers coming in. Now it has turned into, will this company, can this company sustain itself on free cash flow basis? And we are increasingly seeing that they can, because a lot of the cost cuts are in their control. Why I think that it's a respectable turnaround is because the other part of the growth, or the other part of the business strategy, is top line growth, and that is not fully in their control. We are still questioning the size of the market, the company's ability to drive subscriber growth going forward, and the balance of growth and profitability.
Well, what is that longer term top line perspective? What should this company be doing? Because, of course, at the height of the pandemic, everyone was modeling Peloton as if every single household around the world would no longer go back to the gym, and we'd have a bike, a rowing machine, and a treadmill too.
Yeah, I think that the pre-COVID and even during COVID growth rates are less likely to be repeatable. I see this market growing in the mid to high single digit growth rate. The reason is because perhaps this company benefits from very healthy retention rates when compared to other subscription businesses, but at the same time, compared to its prior retention rates, the churn and retention could be getting worse because of the change in their business model. It's slightly impacting the muted growth rate. And the second thing also is that the market is not as big enough as we thought in terms of their ability to penetrate into every single household. And that makes us think that if the market is growing in the low to mid single digit growth rate, Peloton can grow a little bit faster than that, but the double digit growth rate would be aggressive.
Shweta, I'd love to get your perspective on what happens when the leadership at Peloton runs out of assets to sell. They mentioned that they tried to sell Precor, couldn't find a good price for it. Facilities to close down, headcount to reduce. So what takes place out of there when you're still looking at a demand environment that's saying, well, why do I need a new clothes rack to put in my house? And I can essentially just get a gym membership somewhere else or get another type of connected fitness device.
Well, we are looking at fundamentally a more attractive business with potentially a leaner business structure, positive free cash flow, and a very healthy subscriber base. And so do I think that the company will be a standalone, large, mega cap stock sort of a name? No, I don't. I think that their exit strategy would be to be an attractive business for a potential buyout, for example, where they still have very healthy subscription-based contribution profit is 70%, about 1.2 billion in contribution profit. With a healthy subscriber base, you could pay 4 or 5 times that, and that still becomes an attractive business. And so that in itself could be an exit strategy for them down the road.
Is there one company that you think really would covet a Peloton, that after all of their cost cuts, profits are starting to improve? To your point, they have subscribers. Is there one or two companies that you think Peloton may be sold to?
That would be pure speculation, and I would like to steer away from that. But what I've read in media and other reports is, it could be varying range of companies from Nike to Apple, or it could be a private equity firm coming in and turning it around. But so a range of outcomes, but they all seem, according to sources, as potential candidates. Sorry, but there could be some regulatory issue depending on which company we're talking about to keep in mind.
Yes, definitely a good caveat, but a lot of different routes that Peloton could take. Sorry for the pun. Evercore ISI Director of Internet Equity Research, Shweta Kajuri. Thanks so much for joining us. We appreciate it.
Thank you for having me.
Coming up next, we got a little bit of economic data that we're going to be talking through. That's next. Welcome back. We've got some economic data we want to run through right now, just coming out at the top of the hour. Let's start here with the ISM Manufacturing Index coming in at 47.4. That's versus the 48 that was estimated. Prices paid, though, coming in higher than estimated as part of that 44.5 versus the 40.4 that was estimated from analysts. By the way, this measure of manufacturing down for the fifth straight month. It is now at the lowest since May of 2022. At the same time, we got the JOLTS job openings, which we are watching very closely, as we've been discussing, and the Fed is too. These are the numbers for December, and job openings rising to 11.01 million in December from 10.44 million the prior month. So still seeing increases in job openings. This is not what the Federal Reserve wants to see. We will be discussing much more in a moment, but stocks remain in the red. Coming up next, investors bracing for that Fed decision at 2 p.m. Eastern. We'll break down what to expect with Goldman Sachs' Gurpreet Gill. That's next.
Welcome back, everyone. Let's kick off this 10 a.m. hour here with just a quick look at the markets. Major averages are in the red. We had some fresh economic data that we just broke for you prior to the break here. And the major averages right now down across the board. The Dow is lower by, it looks like, about 0.5% right now. S&P 500, that's lower by about 0.25%. And the Nasdaq also in the red as well right now. Also, today's comments from Fed Chair Jay Powell might already be priced into the market, but our next guest thinks it's worth looking at patterns for just how long the Fed expects to hold rates against inflation and whether that is priced into the markets. Joining us now is Gurpreet Gill, who is the global fixed income macro strategist over at Goldman Sachs Asset Management. Great to have you here with us this morning. Okay, so take us into your thesis here and whether or not you believe that today's commentary from the Fed is already priced into the markets, and if not, then what would you be listening for?
Hi, well, first of all, thank you for having me on the show. Fed Day has potential to be quite an auspicious day for markets, depending on whether we get a hawkish outcome or not. In terms of what we're looking for today, it's really what signals we get on the policy playbook after today's meeting. So today, it's widely anticipated that the Fed will step down the pace further to 25 basis points in terms of their rate hiking path. But we are going to be gauging whether there's any changes in the meeting statement language, particularly the phrasing, which currently states or alludes to ongoing rate hikes. In some ways, that suggests that this hiking path is on autopilot. And so any adjustments there that indicate the Fed is going to move towards more of a meeting by meeting approach would give us confidence in our current outlook, which is for the Fed to only deliver one more 25 basis points rate hike after today, and then pause thereafter for 8 to 10 months. And so there you have those P's. So the pace is slowing. The peak is likely 4.75% in our view, and the pause will be 8 to 10 months. And the final P that markets are focused on is whether the Fed pivots towards easing. In our view, the inflation data isn't going to evolve in a way over the coming months that warrants easing. And so we think market pricing for easing later this year is somewhat misplaced. But at the same time, we are probably slightly more dovish in the near term in that we don't expect a rate hike after March, unlike current market implied pricing.
Gurpreet, at the same time, if the job data existed in a vacuum, wouldn't the Fed have to keep on going? I mean, how much of a problem? We just got job openings at 11 million, rising again, right? We still have growth in the job market. How much of a problem is that for the Fed and for those like yourself who are thinking they're going to get more dovish?
Well, there's a few things to unpick there. The first point is that the Fed has a dual mandate, so they are targeting both full employment and price stability. The second point is that healthy job growth is not concerning if it's not accompanied by an acceleration in wage growth that can cause issues for the inflation objective. And so if the labor market remains healthy, but wage growth is decelerating, which is what we've encouragingly seen in measures like the employment cost index for the fourth quarter, which was released yesterday, that also happens to be the Fed's favored measure, then that is not necessarily problematic. And so what we are focused on is how much labor market rebalancing is needed to keep that trend intact of decelerating wage growth. And so we think the jobs workers gap, for example, needs to compress further to around 2 million to be consistent with wage growth of 3.5%, which is compatible with 2% inflation. We're not yet there. There's still further progress to be made. I wouldn't read too much into 1 month's job openings data. I think the Fed is going to be looking at this data set holistically. And today, the task for Chair Powell is to balance the encouraging progress that we have seen without sort of inducing any premature easing of financial conditions, because he will also reiterate that the job is not yet done. In some ways, the deceleration we've seen in inflation is the easy part because it's come from goods and commodities. The path to 2% from here is where things are more difficult because you need that core services inflation to come down. And for that, you need wage growth to come down. And there's a lot of uncertainty around that.
Is there something that the Fed chief could say in his press conference that might spook the markets?
I think that's incredibly difficult to predict. I think we need to focus on the balance of how Chair Powell characterizes the progress on labor market rebalancing and what that signals from the past here on out. I think he will be very careful around his word choice on that. But I think big picture for investors, the focus is that we are past peak inflation. We're probably past peak policy hawkishness. In 2023, market concerns have shifted from inflation fears to growth worries. And so for fixed income markets, we think this means that bonds will sort of reassert themselves as a hedge or a provider of balance in multi-asset portfolios. It's why we titled our 2023 outlook Bring On Bonds. That balanced property improvement combined with higher income and total return actually sets the stage for quite an opportunistic year ahead for fixed income. And it would be remiss of me not to mention January performance, given we're here on February 1st. So fixed income and assets more broadly were off to a stellar start to the year. We saw US investment grade, for example, deliver a total return of 4%. That comes after a 15% decline last year. We also saw a very forceful rebound in areas like Asia credit, and both of those markets we actually see investment potential in.
And Gurpreet, that's part of the reason, right? That goes toward explaining why we have seen rates falling at the same time that we have seen still a tightening from the Fed. So just to take the 10-year as an example, 6 months from now, where would you forecast that yield?
I wouldn't make a specific point forecast on any treasury yields. When we're making investment decisions in fixed income markets, we're really looking at what is priced in relative to our assessment. So right now, our bias in macro markets is to be slightly overweight US rates on a cross-market basis, because like I mentioned, we hold a slightly more near-term dovish view on Fed policy relative to the market, whereas in markets like Europe and Japan, we are more hawkish than market implied pricing, and so we have a bias to be underweight there.
All right, we'll leave it there. Gurpreet Gill, global fixed income macro strategist at Goldman Sachs Asset Management. Always good to see you. We'll talk to you soon. All right, before we head to break, let's get a look at Apple as the street eyes the company's earnings Thursday evening. Barclays analyst Tim Long is sending a warning to investors ahead of the results. Says Long, we see a miss for the December quarter across hardware and services. The March quarter looks to be at risk due to deteriorating demand trends. Long adds he sees pressure on Apple's earnings estimates and valuation this year. Coming up, investors are reportedly seeking compensation for the New York Stock Exchange malfunction. Julie will discuss that, plus have more top headlines next.
Welcome back. Let's get down to business, dig in on some of the latest headlines this morning. The world's biggest EV battery maker, CATL, it's planning to raise at least $5 billion by listing global depository receipts in Switzerland. That's according to various media reports. You see behind me the shares trading in China. GDR is a way a company can issue shares in a foreign market, and this would mark the largest such issuance by a Chinese company. It could come as soon as May. Switzerland isn't uncharted waters for businesses from that nation. 9 China-based companies raised $3.3 billion there in 2022. Meanwhile, investors who were hit by a malfunction at the New York Stock Exchange last month are looking to recoup their losses. According to reporting from Bloomberg, thousands of claims have been filed by brokerages, including Charles Schwab and Robinhood Markets. Similar action has been taken by market makers like Virtu Financial and Citadel Securities. The glitch caused a huge spike in volatility before trading on various stocks was halted. The reporting says the claims are likely to exceed the $500,000 that the exchange operator set aside for that disruption. And the sell-off in shares of Adani Group continues. The fallout real for billionaire owner Gautam Adani. He has slipped to 15th on the Forbes rich list with an estimated net worth of $75 billion. That's a loss of $12 billion in just a week. Adani no longer the richest person in India or in Asia. That title is now held by his rival, Mukesh Ambani. And it comes after short seller Hindenburg Research alleged the group was perpetrating, quote, fraud and stock price manipulation, claims Adani has strongly rebutted. Brad?
All right, thanks, Julie. Private sector job growth that slowed in January, with the U.S. adding 106,000 jobs in January as record floods and back-to-back storms weighed on employment. ADP's chief economist, Naylor Richardson, joins us now to help us understand January's national employment report. Always a pleasure to grab some of your time here. If you were to describe this month in one word, what would that be? And, how does that set us up as we go into February here and kick things off?
I've already failed the first test. I couldn't describe it in one word. It was a weak week and a sound month. That reference week that we use to produce the monthly report, the same reference week that the BLS uses, the 12th, that includes the 12th day of the week, happened to be the week where we saw a lot of weather disruptions that played out that week. But if you look at the rest of the month, it's solid hiring. It mirrors the hiring we saw in November and December, strong, solid growth for this point in the recovery. And it also reflects where we were heading into December, according to the latest JOLTS data, still strong hiring demand. So this week was an aberration and a relatively solid month for January in our view.
Hey, Neela, it's Julie here. You mentioned those JOLTS numbers, which were surprising at 11 million still and rising. Just on an anecdotal basis, right? I go into retailers, not a lot of people on the floor, right? It feels like many of the openings and many of the sort of gap, if you will, in hiring is still happening on the services side, on the retail side, on the hospitality side, on restaurants, et cetera. Is that what you're finding in your data?
That's what you can actually see in the data. You can see it in this report. Basically, work that you typically do outside, work that is susceptible to January weather, was down. So we saw weakness in construction. We saw weakness in transportation. We saw weakness in natural resources and mining. What was up, Julie, is what has been up in terms of the industries all 2022, leisure and hospitality. You do that inside a lot. That was a really robust sector. It continues to really lead the jobs market, and you see that. So there is shortages still. You're seeing it in that sector, certainly in the service sector. It's the services where we're seeing the most buildup in wage price inflation, and it's services that were hardest hit by the pandemic.
Given the sluggish we are seeing in the economy right now, Neela, do you still expect that seasonal boost in hiring once the weather improves?
Yeah, well, we already saw it. We already saw it for January. We saw 1 week that was weak in terms of hiring, but it was couched between some strong weeks. So, yeah, we think that continues into January and February. Now, I do think that as the economy starts to slow, we'll start to see, and we've already seen a deceleration in job gains over the course of 2022. I think we get, even steadier and slower as we round the corner into the new year. But those slower job gains don't bode right now into softness in the economic front. It just means that the economy is normalizing. What's still very abnormal is wage growth. And if you look at our pay insights data, you see that wages are still way above what the Fed would consider consistent with a 2% target. They got to be worried about the labor tightness, especially with the JOLTS report, and wages that have moderated, yes, significantly, but are starting to plateau at these higher levels.
And so with that wage growth that we'd seen in this most recent month, do you believe that employees are still trying to offset any pain that they might be feeling in their purchasing habits or in their expenditures by looking for jobs that give them the ability to kind of outpace the rate of inflation in the core things or basket that they may purchase on a regular basis?
If you look at that JOLTS report, they got a new breath of air in terms of maybe what's open and what's available in terms of new job opportunities. In fact, we saw workers who switched jobs in the month of January see, again, a bump up in pay after that pay was trending down. So there's still gains from job switching in this market. What's important about inflation, even as it moderates, is those prices don't go down, except for gas prices. They've gone down. But generally, when inflation goes up in our core basket, when it comes to housing or clothing or any of those core fundamentals, medical care, they only grow at a slower rate, but the prices are already there. So what that means for the worker is they're still in a position to need more money to keep up with their standard of living that they experienced last year. Real wages have declined in the face of inflation, and it means that workers are still trying to keep up. And so, yes, I do expect that searching to come up even in this inflationary environment to continue.
ADP Chief Economist Naylor Richardson, always a pleasure to get some of your time and insights and help break down this report. Thank you.
Thanks for having me.
Definitely. Guys, coming up, Meta earnings. They're on tap. We're going to break down what to expect from the tech giant and focus on the pain in the ad markets specifically. All of that next. Meta's earnings are on deck, and all eyes are on the ad space as the tech giant faces a weaker advertiser demand environment amid a growing competitive social media landscape. Here to set the scene for what to expect when Meta Platforms reports their earnings, Yahoo Finance's Ali Garfinkel. Ali?
It is great to see you in real life, Brad. So when it comes to ads, the words I'm hearing here are softness and stabilization. So we can only take so much from Snap from yesterday, but Snap management yesterday wasn't necessarily optimistic, but they're saying maybe the ad environment is stabilizing. I think the real test of that will be today. Analysts have come into this cycle expecting softness, right? In Meta's case, they're saying they may be more insulated than Snap, but that softness is still going to hit them. The question is sort of just by how much, right? I actually would reference Doug Anmuth at JP Morgan. What he said was that Meta is going to benefit from its base of 10 million plus advertisers. So that can help them show some resilience here, theoretically, right? It's important to remember that we're talking about ads, especially in the context of Meta, that this is fundamentally a macro issue, right? You have a butterfly effect scenario playing out where you have, inflation goes up, companies cut budgets, those ad budgets have gotten cut, including at tech companies. The way I've sort of been explaining it to people is that with the ad market, we've been watching dominoes fall in real time. And once the dominoes are over, it's hard to get them to stand back up. And that's the ad market that Meta's in today. And Meta is an ad company.
Well, can they still, given that weakness in ads, can they push forward with these aggressive investments in the metaverse?
That's a great question. We know analysts are going to definitely be watching Reality Labs losses. There was a question someone asked me recently that was, do we even care about the metaverse?
Do we?
I think, I don't know if anyone at this table does, but I do think that we are not the audience for it. So I think the real question is going to be, 10 years from now, will the kids today care about the metaverse? The answer seems to be yes. However, we have to care about it today, and analysts care about it today because those losses are racking up, Brian.
I was just looking at the stock and how obviously it was down 60-something% last year. It's bounced about 20% this year. And I think we all recognize that the bounces we've seen in tech stocks don't reflect real optimism necessarily about tech stocks. It's more just sort of a reflexive hope. Yeah, exactly, yes. Exactly. So, are we seeing that there is any kind of optimism baked into the analyst commentary besides just like not doing terribly?
I think there's a lot of optimism is a relative term here. Yeah. I think the optimism of a few years ago is just non-existent at this point, from what I'm gathering. But I think, like with everyone, sort of using words like stabilization, they're like, maybe it's happening, and there's. At a certain point, looking at data, you're going to see what you want to see, and I think people definitely do want to see that stabilization. The question is, what does that really look like? How much does it help? Does the era of real growth tech might be over for the time being?
Interesting. All right. Thanks, Allie. Appreciate it. Let's turn to another tech giant. That is Intel. CEO Pat Gelsinger and other managers are facing a pay cut as the company looks to cut costs. This comes days after the chipmaker posted quarterly earnings that disappointed investors. Yahoo Finance's Dan Halley swapping into the chair right now.
In and out, baby. In and out.
It's interesting. It makes sense, right? Given how lousy those numbers looked.
Yeah, this is just kind of a seeming movement in the tech space where we've seen tech CEOs get a little haircut on their salaries. Gelsinger getting a 25% cut. We saw Tim Cook get a cut. We saw Sundar Pichai get a cut. Gelsinger's, though, is to his actual salary, not his stock compensation. So he's still going to get a ton of money out of this. High-level executives, according to the report, are getting 15% cut, and mid-level employees are looking at a 5% cut. Intel obviously swung for a net loss of $644 million in Q4. They also guided for an adjusted loss of 15 cents per share in Q1. So that's not looking good. Analysts were expecting a profit of 25 cents per share. This is kind of just the continuation of the story that we've heard of tech companies kind of dealing with the backlash from the overexpansion they did. And then now the fact that people just don't necessarily need computers right now. Companies aren't necessarily going out and buying servers, at least on Intel's side of things. AMD is a totally different story. Their data center business did great. They beat on the top and bottom line. The main problem for them is still that client computing, the folks who don't need to buy computers right now. Gamers are also cutting back on spending. So AMD is guiding for a year-over-year revenue decline of 10% for the current quarter. So we'll have to see how that bears out. But, it doesn't appear to me that this kind of storyline is going to be stopping, at least in the next quarter.
Yeah, and for Intel versus AMD, and we were having some of that debate earlier in the show, I guess in terms of the investments that both of them are making, it seems like for investors still, as Julie was mentioning, the kind of, if you pair them against each other, the advantage might go AMD's direction right now.
At this point, as far as investing goes, yeah, it seems that way, right? They're doing better. Their earnings reports are more positive. I think what you have to look at as far as the overall company health, between the two is that Intel is a bigger company. They do more, right? So AMD, they design their chips. They don't make their chips. Intel is making chips. They're building foundries. They're getting clients to have them produce chips for them, right? So this is a company that's more than what AMD has to offer, at least as far as the size and scale goes. And they're jumping into the independent graphics market, the gaming graphics market. That they're not really there yet when it comes to beating out into AMD or NVIDIA, though.
Dan, the next cut might be here to the dividend. Now, I put that question to Pat Gelsinger last week after they reported earnings. I think a little bit of a language shift. He said they want to maintain a competitive dividend. That wasn't a ringing endorsement for paying out what they are paying out currently.
Right, yeah, and I think, when you're looking at these kinds of companies, and you're looking at, how much they're going to have on their dividends here, it really does come down to, I think, how much they're willing to part with just as far as the company's health goes. Again, this is a massive firm, but they have not been doing well for a little bit, right? Their finances were fine during the pandemic when everybody was out there buying computers, but when you looked at the back side of things, obviously we have these issues here, but we also have issues with the fact that their technology just hasn't kept up. That has investors also questioning, okay, so you're putting $20 billion into a plant in Ohio. What does that mean as far as you being able to tackle something like TSMC and prove that you have the ability to build out like they do, or beat AMD when it comes to the chips that you're offering? Because right now you're not. So when will you do that? And I think these are the kind of questions that Gelsinger has to answer. He's taking this 25% cut to kind of say, yeah, we haven't delivered, but you're still getting those stock options, so that's pretty good.
Yes, may not have the base, but still has the options. So we'll see what that looks like going forward. Thanks so much, Dan. Appreciate it. Coming up, President Biden has been pushing for more production of oil and natural gas, and he is getting his wish. Yahoo Finance's Rick Newman has the details. President Biden spent much of 2022 encouraging U.S. and foreign energy providers to produce more oil and natural gas. New data says he could be getting just that, but not in the way he might have expected. Yahoo Finance's senior columnist Rick Newman is here with the details. You've been tracking this quite a bit and the sort of rhetoric between the White House and the oil companies. So what are you talking about here?
So this is a new analysis from the consulting firm Wood Mackenzie, and they look at new exploration for new oil and gas wells every year. And they found that in 2022, there was a lot of new exploration by companies, mostly non-American companies, and almost all of this was exclusively outside the United States. But they found that the value of new fields that were discovered in 2022 was the highest in more than 10 years. And I think that's important because it tells you that we're kind of getting back to business as usual a little bit in the fossil fuel industry. We've gone through a couple of years where they really struggled with losses, and shareholders started to say, we want you to turn the money back to us instead of spending it on new capacity. And that is one reason we've seen a shortage of fossil fuels the last year, let's say, especially with the Ukraine war. But they're opening up a little bit. They're starting to go out and look for new fields. And the data from 22 suggests that we are going to have more oil and natural gas coming onto global markets eventually. This is not, you don't turn this over in a day, but it does show that oil companies are out there looking for new deposits.
A lot of more production, Rick. It seems like that'd be good for prices.
It depends. We're still probably not going to see like gushers of new oil coming online. Here in the United States, for example, there is a very small increase in production, even with prices that were as high as $5 a gallon last year. So there is still what they call in the industry a lot of capital discipline. They don't want to spend too much on new fields, but it's coming online. It's going to take time. There are a couple of wild cards here. China is a really important factor with regard to energy prices here in the United States, especially energy related to oil, which would obviously include gasoline, because one of the things that happened last year is with the Chinese economy and those COVID lockdowns, China's demand for energy really went down, which is one of the things that helped us get gasoline prices lower here in the second half of the United States. Now, China's opening up again. It depends how robust that recovery is going to be. If China really came charging back, I mean, China churns through a ton of energy. And if Chinese energy demand goes up a lot, then that means our energy is going to go up a lot as well. But who knows if that's going to happen. And then the other wild card here, of course, is Russia. Russia, before their invasion of Ukraine last year, was the third largest global supplier of both oil and natural gas. A lot of that is now being rerouted because of sanctions. Some of that is probably coming off the market. So this is going to be very volatile for the foreseeable future. Gas prices now around $3.50, manageable. Not the lowest ever, not the highest ever, not creating outrage among motorists, and that seems to be okay for now.
So what's the significance of this exploration as it kind of correlates to some of the sustainable energy targets that have been set?
Yeah, this was an interesting finding. So what Wood Mackenzie found when they looked at all the new fields that energy companies want to develop is they have found better ways to get energy out of the ground. So energy companies are now looking for, there are different, so burning carbon creates emissions, but getting it out of the ground, extracting it also burns a lot of emissions in terms of the energy you have to expend just to get it out of the ground and the infrastructure you have to build. So they are now trying to find more efficient ways to get energy out of the ground that doesn't require as much burning of carbon or cause as many emissions. Like one example of a way to do that is a new field underneath an existing field. So you've already got a lot of infrastructure in place and you don't need to build new infrastructure. So that is one of the things that has been happening. And the the fossil fuel that is going to be coming online is more efficient in terms of what it takes to get it out of the ground. So that's good news. Less burning of carbon to get the carbon out of the ground. Of course, this is all happening at the same time. There's a huge push to move over to renewables and stop burning carbon altogether. But one revelation of the last year when energy prices spiked is that we are going to need oil and natural gas for a heck of a long time. And anybody who tells you we just need to flip a switch and get over to renewables, that is not the way it works. The global economy still is incredibly dependent on fossil fuels.
And of course, you read Rick's full piece on this now on the yahoofinance.com homepage. Rick, thanks so much.
Guys.
Appreciate it. Coming up, layoffs continue to sweep through big tech, which could reflect major leadership failures. We'll discuss with Bill George. There you see him on the screen right there. We'll discuss with Bill next. PayPal is the latest big tech company to announce layoffs, cutting nearly 2,000 workers amid a challenging macro environment. But as the sector escalates cost-cutting measures, who is to blame? The economy or company leadership? Former Medtronic CEO and author of True North, Bill George, joins us now. Bill, always great to get some time with you. What grade would you give the likes of Evan Spiegel and Mark Zuckerberg on the operational front, given both those companies have announced thousands of layoffs?
Not very high. The only one that hadn't announced big layoffs is Tim Cook at Apple. I think these companies got carried away with overhiring as if growth goes to the sky, and they were not careful, and they just hired willy-nilly, and now they're faced huge layoffs. And I tell you, the impact is going to be on their culture. This is kind of, for a lot of employees, this is the first time we've seen job cuts in tech for about 13 years, since 2009 or 14 years. But I think they're really facing reality, and I think it's going to be a douse of cold water for a lot of these employees, saying maybe this culture is not going to be as great as I thought. And I think they're going to have a real cultural fallout from the kind of arbitrariness. You know, some of them fired people by Twitter. I mean, how would you like to be fired by Twitter? Just no one having the courtesy to have you sit down and talk about it.
Yeah. So, Bill, from that perspective, is there any CEO or leader from your perspective that has done the layoffs correctly in order to maintain a corporate culture at a time where it's extremely difficult?
Well, I think Satya Nadella at Microsoft tried, but they still laid off 10,000 people. So they, too, were caught in hiring too many people. So I think they have not taken it a step at a time, and they've just kind of, boom, there you go. Look at Amazon, 18,000 people. That's a lot of folks. I know it's a big workforce, but still. And I think it's going to have a real impact on how they think about talent. See, here's the problem, is they're still trying to recruit talent. There's still a shortage of talent. So it's not like there's all this excess talent out there. So are they getting rid of the good people, the bad people, or the great people going to stay? Are they going to move on? That's the real question. Because this business, I'm very confident tech is going to continue very strong. These companies are making tens of billions of profits, so they're not exactly hurting financially. They're not doing this because they're in deep financial trouble. It may be because their stock price turned down 20% last year on average. But I really think the real issue is, are they going to continue to get talent after they've been so aggressive in firing people and not doing it selectively?
Bill, last time we had you on, I really valued your insights around how some of the executive leadership can really promote diversity, equity, inclusion at their companies, and especially at the leadership capacity. But when you're going through some of the large cuts, it raises this larger question of how do you still maintain that and the proper way to make sure that you're not just going through, as we had seen in some reports, where you're seeing teams gutted, and that really accounts for much of the diversity, the inclusion at some companies.
Boy, it sure does. And let's just take women for one example, which has been a real paucity of females in top roles in the tech industry. 56% of the cuts to date are women, which is shocking as well, considering the high preponderance of males in these tech roles. So I think diversity is a real issue. And I think there's another issue no one's talking about, and that's remote work. And that people aren't even in touch. A lot of these people have never even been into the office. They don't know people. They aren't working with them. And I can tell you, if the cuts come along, who's going to get cut? It's going to be the remote workers. I mean, I'm out here in San Francisco right now. The Salesforce Tower, the largest building in San Francisco, is largely empty. So I think these companies have to do it. You remember that huge Apple complex they built? Meta has built a huge complex. I think they're going to have to rethink their whole structure, their whole workforce. Why didn't they hire more contract people? You know, that's easy. I don't feel as much remorse when you let contract people go. They're there for 90 days or 180 days. Instead, they hired permanent employees. So at Medtronic, we had a different attitude. As I used to ask the question, if you're going to hire this person, can you assure me we're going to have them through a downturn, which is inevitably going to come? And if not, why don't we just hire some contract people? These are mostly software engineers, so they can be hired on contract.
Of course, Bill, it's Julie here. You know, when things are going well, we feel like they're always going to be going well, right? I guess in some of these situations. So for the companies that have avoided the so-called overhiring, what has differentiated them? How do you think that they have avoided that?
I think they've been more careful in hiring. See, if you really have to be careful when you're going up, to think that this test out whether growth is going to continue, and you can get a little euphoric, particularly at the middle managers that are hiring these people, not really thinking through how assured are we of the growth. I mean, look at Meta and Mark Zuckerberg, totally overhired, $10 billion a year he's spending on virtual reality. Way overhired, and so they're not having to face reality. They should have done that a long time ago. So shame on them. You know, ironically, you've got some great leaders in this field, and but they're starting to learn the challenges of running a company and not just having all these advertising dollars come flowing in. And I think that's the key. So now I think it's going to be a big reassessment about the whole workforce. How do you get talent? How do you keep talent? How do you get diverse talent? How do you provide opportunities for women, BIPOC, non-Americans to reach the top of your company? How do you open up more opportunities? And are we going to have all remote work in tech? You know, and I realize there's real issues there, but I think they're going to have to get more people back into the office, working in teams, collaborating in person, and not just churning out software code. I realize there are people that do that. So you'll always have a certain hybrid workforce. But I think this is going to cause them to rethink. Now, ironically, I think I read somewhere that 28% of the cuts are coming to human resources, which is kind of hard to believe. But HR staffs are going to have to rethink what is their work and what are they doing and how are they helping these CEOs build the workforce they want for the future. So it's not just about cutting back. It's where you're going to go. It's not like the tech industry is in position steel industry is in. No, it's a growth industry. It's going to continue growing.
Bill, you mentioned Apple CEO Tim Cook. Do you think he's one of the most underrated CEOs in the public company game today?
I do, because Steve Jobs gets all the credit. No, like Steve Jobs was a genius inventor, just like Elon Musk is of this era. But Tim has run an incredible company and with great discipline in hiring, great discipline in quality and turning out. Now, he is in the product business, so it's not just turning out software, but yeah, they do a tremendous amount of software. And I think he has done that very, very well and been careful about overhiring and going overboard in kind of the new thing, chasing that. And I think that's the big risk.
All right, well, we know that they're going to be reporting earnings tomorrow, and we're going to hear the silky smooth voice of Tim Cook. We'll see what he has to say on the call. Former Medtronic CEO, also silky smooth voice, and author of True North. Bill George, thanks so much for taking the time today, Bill. Appreciate it.
Thank you. Anytime. Join me on your show.
Absolutely. And everyone, coming up on the other side of this short break, Western Digital getting a big investment from Elliott and Apollo. We're going to discuss that next. Welcome back. It's time for Cover Time. 3 stories, 1 minute each. We start with this today. Western Digital is falling despite getting a $900 million investment in preferable stock from Apollo Global Management and Elliott Management. The preferred stock will have a conversion rate of $47.75 a share here. You're seeing shares move lower by about 3.75%. But even with that, the quarter wasn't great for Western Digital as well.
No, I mean, anything that is sort of touched by PCs right now is not, is not doing great. They make NAND, NAND flash memory. And so that seems to be what's to blame here, that people are overweighting the quarter. I mean, also, it's not sort of a straight investment from Apollo and Elliott. If this convertible preferred stock means at some point when it converts back to shares, that'll dilute value for existing shareholders. So maybe that's a problem too.
And of course, as we should mention, Apollo is the parent company of Yahoo Finance. Also, Western Digital getting a new board member, Reed Raymond. I believe he's on the Yahoo board. He will be joining that Western Digital board as well. But again, a challenging quarter for this company. Margins down almost 1,000 points sequentially. All right, Altria is getting a boost on the back of its earnings report after announcing a $1 billion share buyback plan. The cigarette maker also said inflation contributed to elevated volume declines in the quarter. I don't really have a lot of great feels or vibes on this quarter. Outlook kind of muted, as you would expect, as the entire world gets off these sticks.
Yeah, I mean, like, what's bad news for Altria is good news for humanity, I think we can safely say.
Yes,
cigarette shipments down 12%, cigar shipments down 3.8%, oil tobacco products down 4.3%. Oil tobacco, obviously, a really big problem in terms of cancers of the mouth, tongue, et cetera. So But, if they're holding on to pricing, I guess that helps the company.
Yeah, company's net lower by about 7.4% over the past year. I think what's critical about this level, as well as a few of the other companies that we're tracking, Peloton at one of those similar levels where if it breaks through, and there you're taking a look at the chart, if it breaks through what would have been the, I think, beginning of December high, perhaps it could continue to kind of break through that own resistance. But anyway, we're out of time.
So let's talk Stryker. One more earnings report there. The company announced a net sales increase of 10.7% year over year, said it's expecting positive sales momentum in 2023. This is a med tech company, medical devices and supplies, and it's one of the best performers in the S&P 500 today, which is why it caught my eye. The company's also coming out with a forecast that is above estimates here, and it looks like in its various divisions, it also beat estimates, whether you're talking about medical med surge or medical surgical devices, neurotechnology, instruments, endoscopy. It really touches a lot of different areas in hospitals, for example.
Hey, if you need a new plastic knee, you need a new plastic knee. You're just going to pay the higher price for it. It is what it is.
Knees, net sales, $552 million.
That's my thesis working out in real time.
Yeah,
there we go.
A lot of people need new knees and hips.
Oh, man, I'm one of them, probably.
Oh, no, come on.
Don't say that.
I'm 23. What's wrong with you?
Well, I mean, my hip was jacked up last year. But anyway, I mean, just taking a look at some of the results, I mean, clearly, if people are continuing to opt into some of the surgeries that are either necessary or elective, then Stryker might be one of the advantageous in the group.
Indeed. All right, we're going to leave you there, folks, as we see stocks still in the red ahead of the Fed. Rochelle Akufo in the next hour going to do a deeper dive into the Snap earnings with Evercore ISI's Mark Mahaney, friend of the show. You don't want to miss that.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Watch the tone. Is Jay Powell ready to push back against suggestions the Fed is in dovish mode? And what does that mean for his language at today's press conference? We take a look at the disconnect between investors and monetary policy. And results matter. Snap shares plummet on a weak forecast because some of the ad numbers signal a hidden bright spot for the likes of Meta and Google. We'll check in with Evercore ISI's Mark Mahaney. And autofocus, car makers battle a toxic combination of price cuts, chip wars, and an economic slowdown on the horizon. But the big question, are Americans still buying? We ask an expert to break it down for us this hour. But first, let's take a look at how the major indices are faring 90 minutes into the trading day. As you can see, they're pulling their collective breath, investors, until they await word from the Fed. You see the Dow there off just about over more than 1% there. The S&P 500 down about 0.5%. Tech-heavy Nasdaq there down about 0.6% as well. Let's also check in on the Treasury market. Bond yield, something that's always closely watched in relation to the Fed. We still see an inverted curve between the shorter-term bond yields, the 5 and the 10. We see there the 5-year down just about 1%, the 10-year off also about 1%, the 30-year in slightly better territory there, down 0.8%. Well, the first FOMC meeting of the year is upon us, and investors will soon find out the Fed's rate hike decision, with expectations set for a rate hike of 25 basis points. However, the lines are blurred when it comes to pinpointing where the Fed lies between dovishness and hawkishness. Here to paint the picture is Yahoo Finance's Ines Ferrer. Hey, Ines.
Hey, Rochelle, that's right. And the Federal Reserve will have this mission, which is to basically convey to the markets that they will be keeping rates higher for longer. 25 basis point rate hike, that's what the market is expecting today. But that will be a slowdown from the more aggressive rate hikes in 2022. Now, the markets this month have rallied, and some strategists are pointing to the fact that investors are thinking, well, the Fed is going to pivot because inflation is cooling. You've got the labor market that's cooling somewhat. So the Fed, by raising by 25 basis points, that will be a slowdown, just anticipating a pivot. The Fed doesn't want that because that means that the asset prices go up, and that means that demand keeps going up. The Fed wants to bring down asset prices, wants to cool the labor market, wants to cool wages in order to bring down demand, in order to bring down inflation. So some strategists have been chiming in, economists. We have Ellen Zettner, chief economist from Morgan Stanley. These are her comments saying where there is a market disconnect is that the Fed keeps saying over and over again, and these are the doves and the hawks alike, that the policy rate is likely to stay at peak for quite some time. Michael Gapin, chief economist from Bank of America, was saying if the Fed is slowing down to a pace of 25 basis points, it's hard to push back too strongly, hard to be hawkish and strong when you just slow down again. And investor Jeff Gunlock saying, I suspect Fed messaging will push back against the pivot narrative, and thereby current bond market pricing should be interesting. And finally, just want to point out Macro Alpha, Alfonso Picocello. He has been on with Jared Blickery on Uncut. He says Powell will try to convince markets of higher for longer and probably calm down animal spirits. A hard job. Basically, the Fed doesn't want the markets to rally because otherwise that does make their job harder. Rochelle?
We'll have to see if investors believe that even as we continue to see them slow down the race of pay hikes, whether that's actually going to end up meaning that the Fed is going to have to at some point make a more dovish move here. Great stuff there, Ines Ferrer. All right, well, following a chaotic 2022, investor expectations are set for the Fed to trim the size of its rate hike again, as the narrative for a pivot remains unclear and recession concerns linger. Well, what does this spell out for the year ahead? Here to discuss is Dana Dioria, InvestNet Co-Chief Investment Officer. Good to see you, Dana. So a lot of optimism priced in here at the moment. They'll be looking at that basis point hike, but wondering, should we really believe the hawkish tone of Fed Chair Powell given this movement? What's your take on how investors are really reacting right now?
Yeah, it's amazing. It's actually so interesting because, don't fight the Fed, right? But the market is absolutely sending a different signal. The market is absorbing the economic data that we've seen come in. There's absolutely an expectation of a pivot and, a lower terminal rate. And, as not only just this year, but even more so as we move into next year. Meantime, the Fed keeps telling us, no, expect a higher terminal rate, 5 or above. And we're going to hold or hike and hold, right? So even when we're done actually hiking rates, we'll be holding it for a while. So I mean, the question, of course, becomes, how do you as an investor sort of react to this? And I think, some of it is yet to be determined, right? We'll see economic news that may or may not impact the Fed, but net, I think assuming that the Fed will pivot earlier than what they're saying is a riskier kind of a bet. I think it stems from years of having the Fed kind of step in. And that was years, you got to remember, of inflation not being what it is today.
Is there anything you think Powell could say at this point that would really surprise the markets?
I think Powell has to stay on message. There are things he could say. I think if he was, more dovish than folks expected, that would really, that would surprise the markets, right? But I don't expect that at all. I expect actually that he's going to stay on message. And even if, there is the thought of, hey, depending on where the data goes, maybe we do ease off a little bit more quickly than expected. He's not going to say that today to the markets at all. I mean, we have sticky wage increases. We have earnings expectations being put into the market now, right? Declines in earning expectations, and that's happening kind of slowly, right? As companies come out, analysts are slowly sort of downgrading expectations related to things like operating margins, companies not able to necessarily pass on greater price increases at the rate that they were facing in terms of wage inflation, et cetera. So all that has to work into the market, but I don't expect any unexpected news from Powell today.
So then as we look at things as they work their way through the market, as we look at the Fed's medicine still waiting to take hold in the broader economy, then what does that mean in terms of how you allocate your assets in this period?
Yeah, look, a few big takeaways. One, and you're hearing this, I think, a lot of places, but if you're not globally diversified, if you've had this mantra in your head about the last 10 years, US outperforming and why do I need, international stocks? I think we actually just recently had, with the mild winter that Europe is experiencing and the change from expectation of a pretty hefty recession in Europe to now, hey, they might avoid recession altogether. It really kind of tells you something about markets in general, about the value of prognostication at that level. If you're not globally diversified, you really should be thinking about that. Markets are cyclical. 10 years of US outperformance, yes, but what happened in the last decade? It was 10 years of earning nothing in the S&P 500, but if you were internationally diversified, you had return coming to you.
And obviously a lot of focus on the Fed, but what are some of the risks that investors also need to be paying attention to? You mentioned international markets, you have China reopening, you have the debt ceiling. What are some of the biggest risks you think that investors should be paying more attention to right now?
Yeah, I think we have, the market has short-term risks and they have long-term risks. Short-term risks, the debt ceiling debacle, it's just painful that we have to continually go through this. I think the US and Denmark are the only two countries that have this sort of a system where we spend the money, right? The debt ceiling debate is about paying the bills that we've already created. It's not about future spending, but we do this to ourselves, right? Where we have to now play fast and loose with whether we're going to pay the bill or not. So that's going to roil markets. And depending on how much brinksmanship, we saw what happened, in 2011, and it was pretty painful on markets. So I think that's a risk short term. You mentioned it, China reopening, where that goes, the bad economic data coming in, markets repricing on earnings, et cetera. Earnings not probably going to be what, even they're forecasted now. We've got more repricing to go. Long term, we're pricing in more structural differences. Are we going to get back to inflation at 2%? Or are we going to be living in a world with a little bit higher inflation for longer, 3% maybe, et cetera? Those are longer term risks. And that leads you to say, hey, PE multiples may not be what they were in the past. The expected return on stocks may not be what it has been.
And at what point do you think we'll get to some sort of sense of normalcy? Obviously, it's still macroeconomic pressures, still weighing on earnings, keeping an eye on margins. At what point do you think we'll see perhaps a leveling off of some of this volatility?
Yeah, it's an interesting question because what is normal, at this point? So much change in the last few years. We've gone from a world where tech is kind of defensive to back to growth being more risky because, there's cost to money. I would say in terms of normalcy from the Fed, we are getting there. The highlight I would say is last year we had so much volatility in terms of just these very abrupt and very high increases. Now, at least we're kind of in a place where the data's coming in where we expect it to, right? Inflation's coming in where we expect it to. We're seeing a rolling over. So I do think that markets will benefit, if not by a Fed pivot, by some understanding of what the Fed's going to do, not as much volatility in what that rate is going to be. And I do think to a certain extent that is its own return to normalcy.
And as we await a pivot, whenever that does end up happening, obviously we still have to have a pause before we even get to the pivoting point. Then how should people start looking at their portfolios, trying to plan for the future right now?
Yeah, well, so in addition to, kind of that whole global diversification, we do get asked about, should fixed income be part of the portfolio or in the same, amounts that it was. And I would say planning ahead, you do want to think about what your fixed income position is in the portfolio. You've already experienced a lot of the pain, right? So watching the ag drop 13%, double digits in the same year that the S&P drops 18%, very painful and raises questions about, the traditional 60-40. But on the other hand, how much more pain do we really expect? Even if the Fed goes as high as it says it is, and the market has to reprice a little, that's nothing like what we experienced last year. So I would say, just dealing with advisors and retail clients, looking at how much ballast you have in the portfolio, whether you expect a pivot and great markets ahead or not, making sure you're paying attention to that client's risk tolerance and say, do I have the right ballast? Do I have, safer assets in there at the rate, at the allocation that they need to be?
Certainly have to take a closer look at portfolios right now. A big thank you there to Dana Dioria, InvestNet Co-Chief Investment Officer. Thank you so much. All right, motorsport games rocketing for a second straight session. The Florida-based game developer getting some good news from the Nasdaq. It has now regained full listing compliance. Now, the requirement says the majority of a company's board must be comprised of independent directors. This morning's pre-market gain was even more impressive, the stock jumping over 200% before regular trade there. Still, at the moment, they're up 71% as we head into the noon hour. All right, coming up, the earnings roundup. We take a look at why Snap is tanking and preview Starbucks' first quarter report. Stick around. Snap in focus this morning after reporting mixed earnings. According to its CEO, the flat year-over-year growth reflected the rapid deceleration in the company's digital ad growth. Joining us now to break it down is Mark Mahaney, Evercore ISI Senior Managing Director, Head of Internet Research. Good to have you join us this morning, Mark. And we know, obviously, ad spend front and center for a lot of investors at the moment. In terms of this wider tightening on ad spending, how much of the issues when it comes to Snap are Snap specific?
Okay, that's the right question, Rochelle. And there's clearly there's clearly softening in overall advertising spend, whether it's offline or online. And it's that pace of softening seems to have accelerated. You know, Microsoft talked about that too on their earnings call, and they account for about 10, 11 billion in ad revenue. So that was a very chunky data point, and their guidance implied acceleration in that deceleration or accelerating deceleration in the growth rate. So softening is continuing into the March quarter. That's exactly what we heard from Snap last night. So there's a lot of stuff here that's macro, but there are things that are also Snap specific. This company is trying to do a redo of some of its ad platforms to counter the impact on its advertising efficacy from the Apple privacy changes. There's also a lot of competitive risk that Snap's facing. Their daily average users, that growth is starting to slow down a little bit. So that could be the ongoing impact from TikTok and maybe YouTube Shorts. So the answer to your question is it's both. There's macro and then there's company-specific factors.
And as we look at some of those changes, especially with its direct response business when it comes to ads, I mean, that's really been a lot of bread and butter for Snap here. How is it going to really maintain its competitive edge here? I mean, for those who don't know, this is those ads when they come up, it's an immediate call to action to buy something or sign up for something.
And that's really been the power alley of internet advertising, direct response advertising. There's some channels in the internet that are good for brand advertising. Netflix is building out one, but generally the bread and butter, the power alley for internet advertising has been direct response advertising, because historically it's been so measurable, and you could in real time adjust campaigns. So there's a wonderful efficiency associated with it. Some of that was undermined by the Apple privacy changes, but a lot of it's still intact. The issue for Snap is that there are other companies that do this. There's two in particular that are really large in this space. One's called Google and one's called Meta, or Facebook, Instagram. And so Snap's always had this problem, like some of the other platforms, like a Pinterest and historically a Twitter, where they're not a primary ad buy. They're a secondary or maybe even a tertiary ad buy. And if you're going into an advertising recession, what you're going to see is a lot of marketers consolidate that spend to just the one or two platforms. In good times, you diversify your spend. In bad times, you concentrate it. So it just kind of adds to the pressure on Snap's fundamentals today, and that's why they're likely to show year-over-year decline in ad revenue in the March quarter.
And we did see some downgrades, including from UBS today. But you've kept an inline rating here and also have a price target, lowered your price target from $14 to $12. Talk about why you have still this inline rating for them.
Well, the stock's trading at around 3 times EV to sales, enterprise value to sales. That's sort of the trough level it's been at. And so what you have to ask yourself as an investor is, do you think things are going to get materially worse? Multiple will go down if fundamentals get materially worse. They are correlated. I'm not, our sense is that we're going to see kind of a macro recovery in online ad spend later in 23. And I think that a lot of the changes that are going on now at Snap that are near term undermining their direct response advertising, but I think can long term help those trends. I think they're retraining their algorithms and using artificial intelligence too, kind of like what Meta is doing, except that Meta's just got so many more resources and started doing this more aggressively, call it 6 or 9 months ago. So they're ahead of the curve, whereas Snap's behind the curve, but there is a curve. And so on the other side of that curve, I didn't ruin the analogy, I think you could see Snap's fundamentals recover. So that's why I kind of want to stick to the sidelines on it. I don't think it's a sell here, but it's not a buy either. I think you've at least got a couple of quarters before you could consider being constructive on the name.
And in terms of what you liked in the earnings report, what else stood out to you?
Frankly, not much. This was mostly a negative report, but there is this new asset, somewhat newer asset. It's called Spotlight. So for all the Snap users out there, they know what I'm talking about. It's kind of like their TikTok offering. So if you're on the screen far right, and you get a lot of short form video, and it can be highly entertaining, addictive, like most short form video platforms, TikTok, Reels, YouTube Shorts. But it's a nice integration. And this is one of those, you look for those opportunities that companies have assets that they under monetize because it's a new revenue growth opportunity. Spotlight is one of those. They have very little ads, very little ad intensity in there, but there's no reason why over time they can't better monetize that. So I think that's kind of one nice little area. Then Snapchat also has a subscription service that I think has got about 2 million users. I don't know how big that gets, but it's a nice diversification of the business model, a little bit away from advertising. I think those are two kind of modest positives you could have seen through in all the gloom last night.
And as you mentioned, Meta and Google, obviously with Instagram Reels and the YouTube Shorts here, how does Snap then position itself in that conversation when you already do have these heavy hitters? Like, what room does that leave in terms of a competitive edge for Snap?
Well, Rochelle, you're asking a good question, and arguably it's a very bearish question, which is, what's really special about Snap? What is special about Snap is this demographic hold that they have, and it's something like 70% of 13 to 24-year-olds in, a couple of dozen countries are on Snap. So it's very popular with younger users. Now, primarily for messaging. I've got a bunch of teenagers at home, and they use Snap, and that's how they communicate. They don't text like you and I do, Rochelle, or maybe email. They chat with each other. So there's a very strong demographic appeal. And so for marketers that want to pitch products to that particular demographic, Snap gives you that, and they've got pretty good reach. They've got well over 300 million daily average users, not monthly, but daily. So they have a very engaged, very tightly defined demographic. So for some marketers, that I think they could be a very attractive end market. And also, I want to give Snap credit. They've been generally very good at product innovation, over the years. And I think that's one of the reasons why they get a very strong, very good positioning with this demographic, and they still have one of the best user growth profiles out there amongst the social media assets.
We'll see if they're able to find a way to monetize that more effectively. A big thank you there for joining me this morning. Mark Mahaney, Evercore ISI Senior Managing Director, Head of Internet Research. Thank you for joining me this morning.
Thanks, Rochelle.
All right, well, Starbucks is expected to report its fiscal first quarter results Thursday after the bell. Now, many analysts are keeping a close eye on consumer spending power and sales in China. Brooke DePalma is here with the details. Hey, Brooke.
Good morning, Rochelle. Starbucks once again looking to report earnings results Thursday after market close. Analysts expecting a boost in revenue here as the U.S. continues to benefit from those higher prices, customization, like the ability to add that pistachio syrup to your coffee, as well as the addition of food to offerings. But as you noted, Starbucks in China, a different story there as the COVID-19 zero COVID-19 policy comes to an end. Taking a closer look at Bloomberg consensus estimates here, revenue expected to come in at $8.75 billion. It's up nearly 9% year over year. Adjusted earnings per share expected to come in at 77 cents. That's up 2.7%. Once again, U.S. same-store sales expected to get a boost there as the U.S. customers seem seemingly unbothered by those price hikes, up nearly 9.26%. International sales brought down by China, down about 13.31% in China in particular. Howard Schultz, interim CEO, expecting to come out as the number one Western leader and certainly the number one undisputed leader in the category in China, despite the headwinds that they face there. But here in the U.S., menu pricing, inflation, a hot topic that it's expected to be on the fiscal first quarter earnings results. Worley, Howard Schultz sees it as an affordable luxury here in the U.S. And last earnings results, Starbucks did in fact see that fifth consecutive quarter of larger transactions thanks to those higher prices and customers adding food to their coffee orders. Yahoo Finance asked CFO Rachel Ruggieri, that is, if she expects price increases this fiscal quarter, and here's what she had to say.
Our pricing in the past year in FY22 was really in response to inflationary pressures. We'll have some of that this year based on annualization from moves we made last year, but we expect our pricing to return to actions that are more on a historical level. What we focus on is really how do we sustain that ticket? Because it isn't just pricing, it's actually volume as well. We've seen our customers purchase more. That's evidenced in increased attach. So we're seeing increased volume.
And Rachel went on to say that Starbucks' key competitive advantage is having food and beverage offerings that customers just can't make at home, with innovation as a key tactic. As of last quarter, though, the company did raise prices by about 5% over a 12-month period. Now, this report is, in fact, a look back, but analysts very bullish here. They expect, they have ratings of 15 buys, 19 holds, and only 1 sell on the street right now. So going into this quarter, quite bullish, and some holds there.
And as you mentioned, this report is a look back. So then what's ahead for the coffee giant?
Yeah, well, right there here, February 13th is expected to be the Starbucks Rewards update. So there, investors keeping a close eye on what exactly that means here and if it will deter that transaction amount. Will customers be purchasing less, knowing that it'll essentially cost more to get those free rewards? Now, in addition to that, April 1st, 2023 is a date that we have been looking closely at. April 4th, 2022, last year, interim CEO Howard Schultz came back for the third time. October 1st, they named Laxman Narasimhan incoming CEO of Starbucks. And so that April 1st, 2023 date will essentially be the switch to the throne. Interim CEO Howard Schultz expected to stay as a chairman, or rather on the board of directors. And so lots of eagerness to see what this call will be as potentially interim CEO Howard Schultz, hopefully, or maybe not, last Starbucks earnings call.
So interesting, especially him coming back now to see where the company goes from here. Great stuff. Brooke De Palma, thank you so much. All right, coming up, car dealers and sellers continuing to see inventories improve. But what's the next big bottleneck? We discuss next. Time now for our chart of the day. And if you're a US car buyer, it's not just the paint job that's pricey. The average transaction price for new vehicles rose to a record $49,507 in December of last year. And while, of course, some of the blame comes from a lack of inventory early on in the pandemic, creating a lagging effect, rising interest rates also giving prices a bit of gas as well. All right, well, let's continue our talk on the auto sector with a look at the other side of the car buying equation. Dealers and sellers continuing to see inventories improve, with higher rates now emerging as the newest big bottleneck. Here with more, Michelle Krebs, Cox Automotive Executive Analyst. Good to see you, Michelle. So a lot of people wondering, we saw a lot of, good to see you too. A lot of these car dealers, a lot of these car companies had a lot of inventory issues. Now that we're seeing some of them perhaps better than others manage their inventory better, where are we perhaps going to see some of these sales and bargains for consumers?
I think that, we're seeing a very uneven level of inventory. We're seeing a lot of inventory for the domestic automakers, especially in the pickup truck segments, the bigger trucks, and still very tight inventories for companies like Toyota and Honda. So we would expect that that we will see some incentives on, for example, American-made full-size pickup trucks. That's, I think, where we'll start. I think the other thing that will happen is we'll start to see a little more bargaining in the dealership, and maybe people won't be paying quite as much over the list price as they were in the past year. Some of those premiums will start paring down.
And so as we look at some of these interest rates, obviously has been tight for consumers. They have been trying to tighten their purse strings. How much is that going to weigh on consumers as we see the Fed now perhaps is slowing down on some of these rate increases and eventually at some point seeing that trickle down to some of these car prices and interest rates there?
Well, and that's been a huge thing because vehicle prices are high. You mentioned it. The average vehicle price in December was $49,000. We're getting very close to that $50,000 mark. And then you add on rising interest rates, that's making the monthly car payment pushing $800 a month, where even some people are paying even over $1,000 a month. We also are seeing a chunk of people paying cash so they don't have to pay those interest rates. So any movement down should help.
And how does that change the balance then for some new cars versus the used car sales?
Well, used car sales have been very strong. It's a very robust market because a lot of people have been pushed out of the new vehicle market, either by the higher prices or they used car loans usually have a higher interest rate, or people can't qualify for a new car loan. So we're seeing people being pushed more into the used car market. The problem is those prices are going to stay pretty high because we didn't see a lot of leasing. We didn't see a lot of trade-ins of kind of we call them nearly new vehicles that are only a couple of years old. So that part of the used market will be pretty tight.
I want to talk innovation now. I want to pivot to some of these automakers investing in self-driving technology. We had on U.S. Transportation Secretary Pete Buttigieg earlier today. Take a listen.
There's real promise in the technologies that you're seeing from the automakers. Eventually, I think they could potentially save many, many lives. But right now, we're in a period where the technology cuts both ways, and I'm very concerned about car owners relying too much on technology that is designed to assist a driver, not to replace a driver.
And you do have that balance between, reliance on this technology versus assisting. So as autonomous tech becomes an increasingly important part of the car industry, tell us more about that and how you see that developing.
Well, a couple of years ago, everybody was, autonomous vehicles are going to be here any day now. And that's not exactly happened that way. COVID happened. And then, there's just been a bit of a slowdown in that part of the market. But what we are seeing is a lot of those technologies going into vehicles to assist the driver being a better driver. Some will allow you to take your hands off the wheel, but keep your eyes on the road. But I think there needs to be a lot of education done of consumers about what those technologies can do and what they can't do. They don't fully drive the vehicle. And so the driver still has to pay attention and be ready to take the wheel.
And of course, a lot of that coming to the light in conversations about Tesla. And when we look at other EV makers, we saw that rise in interest towards the end of last year. And we're also seeing, of course, the price cuts, not just with Tesla, but also with Ford, with its Mach-E as well. Some concerns about a potential race to the bottom with EVs. How do you see the pricing going forward?
Well, that was a surprise. We saw Tesla put discounts in at the end of December. Their shopping went way up. We saw that on our website. Then they cut prices. They've cut them across the board. In China, that's where they started. Then Europe and North America. And just this week, Ford announced it was cutting the price of the Ford Mustang Mach-E, which is an electric SUV that competes directly with the Tesla Model Y. General Motors has said it's not going to cut prices. Volkswagen has said it's not going to cut prices. We'll see where that goes. But I think Ford really, they're a direct competitor with that specific model with Tesla. So I think that's why they made that move. And Ford has really been gaining traction in the EV market. They made the second most sales by a wide margin behind Tesla last year.
Certainly that competition heating up a lot faster as more models get introduced into the market. Michelle Krebs, Cox Automotive Executive Analyst, thank you so much for joining me this morning.
Thank you.
All right, coming up, falling home prices are a global problem now. So are there other ways to play the real estate sector, or are you better off sitting on the sidelines? More coming up next. Reports this week have shown the US housing slump stretched into a fifth month as home prices abroad slide lower domestically as well as abroad. Now, despite rising interest rates, is now a good time to invest in real estate? Here to weigh in on that and the outlook for real estate investments is Principal Asset Management's Global Head of Research and Portfolio Strategy, Indranil Karlikar. Thank you for joining me, Indy. So I want to ask you, a lot of people, there's a lot of noise out there and a lot of signals to watch. How are you sorting through this and determining what we should be paying attention to when trying to invest in this space?
Yeah, good morning, Rachel. As you said, there's a lot of noise out in the market, and we believe that noise will continue for the foreseeable future. And the rationale is pretty simple, really. If you think about what's happening in the U.S. economy, we're seeing two forces at work. One is inflation, and the other is the Federal Reserve working hard to push that inflation level down. And so what we are telling investors is really focus on those two signals very, very clearly, because the direction of inflation will really determine the direction of the Fed's actions. And unfortunately, it seems that until the Fed, at least from our perspective, the Fed is likely to stay resolute in its wording and its language until it sees very clear signs that inflation is on the way down or feels comfortable that inflation is where it needs to be. And until that happens, we think the capital markets and real estate markets, for that matter, are going to remain somewhat volatile, somewhat turbulent. So what we are recommending investors is really stay focused on cash flows that are resilient, that can withstand the spirit of turbulence that we expect over the next 6 to 12 months. But also be prepared to pivot to opportunities, because when there's dislocation, there's also opportunity. So it's really building a resilient and nimble portfolio in real estate that focuses on the full array of opportunities that is available to a real estate investor, including, of course, the residential sector, but also be prepared to invest more opportunistically, more nimbly in the public quadrants of real estate. For example, REITs, when they dislocate, they might offer some interesting opportunities. So big picture, we're telling investors is be defensive, recognizing that we're going to enter a period of uncertainty, potential recession, but be prepared to be nimble and pivot when the opportunities do arise.
So then looking within REITs, then what are some of the key themes to keep an eye on when really determining when to enter the market and how to enter it?
Yeah, that's the million-dollar question, Rochelle. I think when we look at REITs, we look at it more holistically from the perspective of a real estate owner. And ultimately, REITs do offer a different form of ownership to commercial real estate, albeit in the public side. And so we look for similar things underlying REITs. How is their earnings? What's the cash flow opportunity? How resilient are these cash flows? So when we're looking at the opportunity for REITs, we are looking at which REIT stocks are more resilient in terms of the cash flows, which REIT stocks are able to generate stronger earnings despite the potential uncertainty. So when we're looking at REITs, we're looking at these two underlying drivers. But more importantly, we're also looking at when the timing may occur, when the timing may become more favorable in terms of the quote unquote Fed pivot, the great Fed pivot. Now, the challenge is, of course, it's very hard to precisely determine when the Fed does stop its interest rate tightening cycle. But we believe that time will come when it feels that the inflation outlook has improved materially. And when that timing does occur, the REIT market, the US listed REIT market, will become a really interesting spot to play in. So we're looking for a couple of things. We're looking for the earnings outlook. We're looking for REITs that throw off structurally resilient cash flows. And of course, we're looking for when there are clear signs that the Fed has done, at least for the time being, with its interest rate tightening policies.
And how are you seeing some of these investment strategies differ depending on age demographic?
That's a great question. We believe that the U.S., like any other developed market, is going through a profound change in its demographic outlook. We're aging as a society. We're getting grayer. And that's leading to a whole host of different opportunities, particularly in demographically driven real estate strategies. So I'll pick on a couple as, for example, if you look at the residential market in the US, it's a vast market. But for right or wrong reasons, people have typically, or investors, analysts have typically focused on this owner-occupied residential sector. We think if you step out of the owner-occupied residential sector, there are significant opportunities up and down the demographic scale to invest in it, whether it's single-family rentals, whether it's manufactured homes, whether it's age-restricted housing, whether it's senior living, whether it's assisted living, or it's care living. There's a whole gamut of demographic-related opportunities to invest in the U.S. residential sector. It's not only about single-family owner-occupied homes. And that's just one example of how you can play the demographic shift that's occurring in the U.S. But there's also other ways of playing the demographic shifts in the U.S. And the other is through, for example, the retail market. The retail patterns are changing. 10 years ago, e-commerce as a percentage of retail sales was growing, but it was pretty small. You look fast forward now, e-commerce is about 15, 16, 17% of retail sales. And a lot of that is being driven by the shift in the US demographics. The millennials, the Generation Z, the younger generation, much more liable to purchase and use e-commerce on their smartphones, on their tablets. And that's changing the way the US retail industry is evolving. Bricks and mortars has always been important for retailers, but so is clicks and mortars. It's become really important to have that holistic experience for retailers. So that's another example of how the shifting demographics in the US is actually shifting the way we shop, and that opens up opportunities as a real estate investor. Should you be invested only in bricks and mortars, or should you also invest in companies that give you clicks and mortars?
That's fascinating. I love that. Clicks and mortars. Definitely not something we hear talked about enough. There's so much focus on those single family homes, not as much focus on demographics. Great stuff there. Principal Global Head of Research and Portfolio Strategies, Indranil Karlikar, thank you so much.
Thank you.
All right, coming up, generic problems. America's top-selling drug has lost its monopoly after 20 years and hundreds of billions of dollars in sales. What does this mean for competition and the price of the medication overall? We take a closer look next. After decades of sales and over $200 billion in revenue, America's best-selling drug is finally going generic. Injectable arthritis and autoimmune treatment Humira has lost its monopoly. So what does this mean for competitors and overall costs? Yahoo Finance's Anjali Kemlani is following this story. Hi, Anjali.
Hi, Rochelle. So as you mentioned, this is AbbVie's top-selling drug, absolute blockbuster that treats rheumatoid arthritis specifically, as well as some other diseases. And so what we're looking at is the drop-off of the exclusivity of that patent for AbbVie. And Amgen is coming on with its own biosimilar. There are also a number of others expected this year. Now, this is not new. The part that we know is that these biosimilars have been ready to go. But what AbbVie did really is extend its patent for this drug an additional 6 years from 2016 when it was supposed to lose exclusivity and when the biosimilars were supposed to get on. Now, let me introduce you to AbbVie's Humira, and that is a drug that has, as you mentioned, $208 billion since getting on the market in 2002, $114 billion since 2016 when it renewed that patent, and $20 billion alone in 2022. So that's the market there that they are now competing with another treatment on the market with Amgen. Now, Amgen is doing something really interesting, and that it is pricing its biosimilar at two different levels, 5% and 55% off of Humira's price. Now, why that's interesting is because, as we know, the U.S. drug system relies heavily on PBMs and insurers to take up the control of who gets these drugs, how the formularies work. And what that means is that there's an incentive for the higher list price to be the one that's used. Now, two insurers, Cigna and United Healthcare, have already kind of taken a stab at this by pointing to the fact that they're going to have both AbbVie's drug and the biosimilars on the same tier in the formulary, meaning that it's going to be the same out-of-pocket cost for patients. However, what actually ends up getting prescribed is going to be particularly interesting when we see what the individual's particular insurance plan is, what their out-of-pocket costs are going to be, et cetera. So really an interesting market and really just another look at the U.S. drug system and the insurance system. So we'll have to see what the uptake ends up being. But as of right now, a very interesting case in what is going on with these biosimilars and what happens down the line later this year when 6 others reach the market.
Indeed, and then you add to that, obviously, the Biden administration's push to lower some of these prescription costs. It'll be an interesting time for biopharma this year. Great stuff. Anjali Kemlani, thank you so much. All right, coming up, attention everyone, Netflix is cracking down on password sharing. It's happening. The details next. Netflix cracking down on password sharing and now laying out the rules of requirement. Yahoo Finance's Ali Canal joins us now with more. Ali, we knew it was coming. Still stings, though.
It still stings. We knew it was coming, and now we have the first few details on what this will look like. Netflix updating the FAQ pages for those countries that are already in the midst of this crackdown. So think Chile, Costa Rica, Peru. But the U.S. is right behind them, expected somewhere in Q1. So it's important to see the changes that will be happening to accounts. Number one, Netflix will require users to identify a, quote, primary location for all accounts that live within the same household. So users will need to sign into the home Wi-Fi of the primary location at least once every 31 days to ensure that their device is not blocked. Now, if someone is traveling or uses a device that's not often connected to that home Wi-Fi, the main account holder will have to verify that device through a temporary code which will grant the device access for 7 consecutive days. Now, it's unclear at this point if you can request multiple temporary codes following that 7-day period. My thought goes to myself, who's still on her parents' Wi-Fi, along with maybe college kids. I would just kind of call up my parents every 7 days, give me this code. That's unclear right now. So I do think there are a few kinks that Netflix will have to work out. For example, if you're an account holder that has multiple homes, how do you identify your primary location? So I'm not anticipating a very smooth sailing ride here, but Netflix is certainly using all the tools at its disposal to determine which account is associated with that primary location. They said they look at IP addresses, device IDs, account activity to make sure the device signed in is within that primary household. So they're very committed to this, and they're really hoping that over the long term, this could add to profitability.
I'm sure they're probably hoping people get fed up and just end up having their own Netflix accounts, given how many of us share our passwords. So in terms of that, though, in terms of monetization, what's the outlook been so far for Netflix's ad-supported tier? Are they gaining more subscribers?
Yeah, well, we have some positive news to kick off 2023 on that ad tier front. According to a report from The Information, Netflix told advertisers that signups for its ad tier doubled in January from December. And that's a sign that this new offering is gaining traction, and obviously good news, since at the end of last year, we saw that the ad tier was reportedly struggling. There were multiple reports that Netflix was failing to meet the estimates that they set out, that they weren't attracting those new users. At the time, analysts seemed to shrug it off. They said this is still early days and that over time, the ad tier will gain momentum, which seems to be happening right now. Obviously, ad-supported, coupled with that crackdown on password sharing, that's been seen as a lifeline for Netflix to really get the revenue and the profitability that they want over the long term, especially with all of this competition. So I think moving forward, especially throughout this year, investors are going to be hyper-focused on specific details from both of those initiatives to see if Netflix can get it done.
We'll have to see. I know you'll update us on that. Ali Canal there, thank you so much for that update. All right, well, before we go, let's do a final check of the markets as we head into the noon hour and ahead, of course, of the Fed Day announcement. You see all three in negative territory off their session lows, but still jittery as they await word from Fed Chair Powell. Well, that does it for now. I'm Rochelle Akufo. I'll be back at 11 a.m. Eastern. We'll be back with our Fed coverage this afternoon. Stay with us.